Good morning, everyone. How are you?
Good. How are you?
Welcome to the State Investment Council meeting. This is my first meeting. How exciting is that? Not as exciting for Peter. He's ready to go. But thank you all very much. And I thought we would start with introductions, and we'll go around the table, and then we want to highlight the new members. We've got some really exciting new members on the council. So I'll start. I'm the governor, Michelle Lujan Grisham, and how lucky am I to get to be governor of such an incredible state with incredible opportunity. Can we do it this way? Sure. Okay.
Good morning, Olivia Padilla-Jackson. I'm the Cabinet Secretary Designate for Department of Finance and Administration, and I'm very happy to be here.
Good morning, everyone. I'm Stephanie Garcia-Richard. I've been on the job 3 weeks tomorrow. I'm the new Commissioner of Public Lands, and it is my privilege to be here today, but I don't know if I will add anything intelligent yet. I'm learning.
Linda Eisen, I'm a public member. I was appointed in 2012.
Scott Smart, I have no idea when I was appointed. I'm a public member. I'm the university representative on the committee, and welcome to all the new members.
Governor, I'm Tim Eichenberg, and I serve as your friend.
Hello, Mr. Treasurer.
I'm Tim Jennings, and I'm a representative on here from the Mexico Senate. Been on here for 7 years.
Good to see you, Senator.
So,
I'm Carrie Siegel, the Executive Assistant at the State Investment Office.
Good morning, Matthias Fowler with RVK. We're the General Consultant to the funds.
Good morning, I'm Marcia Beer, General Consultant, RVK.
Charles Wallman, Director of Communications to the Council.
Rick Ship, I'm the Chief Financial Officer at the State Investment Council.
Hi everyone, I'm Evan Lamb, I'm Chief Counsel.
I'm Vince Smith, I'm Deputy State Investment Officer and Chief Investment Officer.
Good morning, Steve Moise, State Investment Officer.
Peter Frank, and I serve as Vice Chair, and I've been on the council since, I think, 2009, probably, on and off. My second term.
We have matching glasses. So we don't want to mess those up because these won't work as well for you, I am sure. Do you want to go around the room?
John Maglin, Chief of Staff.
Jamie Henderson, Areas Management.
Julie Solomon, Areas Management.
Good morning, Jack Koch. I'm with the Townsend Group. We're the real estate consultant for the SIC. We've been working with the SIC since 2011.
Scott Marcus, also with the Townsend.
Justin Greenlow, Entrepreneur and Architect.
Matt Sturtevant, RVK, your General Consultant.
Carol Dunn, Director of Public Equity and State Investment Office.
Dawn Iglesias, Economist and SIC Analyst for the Legislative Finance Committee.
Eric Tyson, Citizen.
I'm Gene Sanger. I'm an advisor to the Investment Committee, and I've been doing that for about 6 years.
Hi, Alan Waldron with Pavilion Alternatives Group. We're the private equity consultant, and we, like Townsend, have been around since 2011.
David Lee, Director of Private Equity, SIC staff.
Chris Cassidy, and work with Dave on the private equity portfolio.
Clay Camper, I'm on Assistant Investment Council on the Real Estate and Real Assets portfolio.
Clark Stuckey, Acting Director of Fixed Income.
Paul Chapman, Director of Real Estate and Real Return, SIC staff.
Great. Well, welcome everyone, and thanks to the returning members, and welcome to the new appointees, or new members, I should say. And with that, why don't we approve the minutes? And they are the November 27th, so I'm moving at the State Investment. I guess we have to do the agenda first.
I guess we do the roll call, but I don't know.
Oh, that's right. See, I'm already forgetting. I stole the whole chairing from Peter, so it's excellent. And then, Carrie, you do the roll call?
I have noted. If you'd like me to do it, I
would, indeed. It says right there I'm supposed to do it, right at the very top.
Governor Lujan Grisham.
Here.
Peter Frank.
Here.
Secretary Padilla-Jackson.
Here.
Linda Eidson.
Here.
Tim Jennings.
Here.
Harold Lavender, we do know that he's on his way, I believe, just stuck in traffic. Treasurer Eichenberg.
Present.
Commissioner Garcia-Richard. Lee Rawson.
He's here. I mean, he's coming today.
He's in the building. Scott Smart.
Present.
And Lynn Hoffman.
She's on the phone.
Participating by phone. Welcome, everyone.
Oh, hi,
Thank you, Lynn. And you do have a quorum.
Terrific. All right, so with that, why don't we approve the agenda? And I actually would do this differently, but it says that I'm supposed to move approval of today's agenda. I suppose someone... Okay. Is there any discussion about that motion and second? Okay. Hearing none. All those in favor? Aye. Anyone opposed? Anyone abstain? All right, the motion carries. Okay, so then we'll work to approve the minutes. I move that the State Investment Council approve the meeting minutes for November 27th, 2018. Do I have a second?
Yes.
We have 2 seconds. Perfect. All right. Do I have any discussion? All right. All those in favor of approving the minutes of November 27th, say aye. 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 Any opposed? Any abstain? The motion carries. The minutes for the November 27th, 2018 meeting are in fact approved. The next item is number 2 then on your agenda, and it is the briefing by the State Investment Officer and Chief Investment Officer. So I'm going to defer then without objection to Steve and Vince.
Thank you, Governor. Good morning, everybody. Welcome to our new members. We're thrilled to have all of you here. As I do at each meeting, we explain what the distributions from the funds have been to the state over the past 12 months. So as of this month, the past 12-month distributions have totaled $939,582,000. The net asset value, the assets under management by the council, as of this morning, totaled $23,941,800,000. And we also mentioned the price of oil. West Texas Intermediate oil is now at $51.96. These are all data points that are important to us, and we think it's important to review them at least each month. Today, we will focus primarily on investments. The council's main role, as all of us know, is to oversee the prudent investment of the funds and to serve the best interests of the funds and the beneficiaries. And that's what we all do each day. About 9 years ago, when Vince and I came in, and this is for the new members, approximately 85% of our investments were focused on public, domestic, and global equity-like investments. Those included CDOs, opportunistic real estate, and Vince convened our consultants and the council and our staff, and we decided we needed to change that asset allocation. So about half of that, 85%, was replaced with more income-producing assets that hopefully were less volatile. They included private equity, core real estate, real return, and that's a word that, those are words that are not familiar to most people. Real return including infrastructure, timber, agriculture, and energy, and fixed income investments. So those were a lot of the changes that were made, and they've proven out. They have served us well. We will discuss our peer rankings with the council from time to time, how we're performing vis-a-vis our peers, as well as our fees. And you'll be hearing more on that from Vince, our consultant, and our staff. Let's talk about distributions. This is a record year for the council. I should say FY20 will be a record year for the council. For the first time, we will distribute over $1 billion to the state. That, I believe, will be about 14% of the state budget. The number is remarkable. It saves each household in this state approximately $1,200 per year in tax. Land grant distributions fund 21 beneficiaries. $747 million from the land grant fund in FY19, a total of $6 billion over the last 10 years. The FY20 distribution out of the land grant fund will be $784 million. Severance tax distributions go to the general fund. $220 million in FY19, $1.9 billion over the last 10 years, and in FY20, the distribution will be $225 million. So the total increased distributions, about $41 million year over year. We have 22 clients, as the current members of the council know. The City of Albuquerque recently asked us to invest for them, and we invest over $1 billion for those clients. These are state governmental entities, and a list of those clients is available on our website. It's available in our 60th anniversary report, and we'll be talking about them from time to time. Governor, did you have a question?
No, Peter's taking care of me while you speak. He appropriately was reading my notes to myself. That tells me I should write smaller.
Or in code.
Or in code. Oh, I could do code, shorthand. I'm old enough where I know shorthand. Okay. Thank you. So please, I apologize. He's making sure that I can follow appropriately.
You have to watch Peter.
I do. I like him already.
About 80% of the distributions that we make fund public education. 85% comes from the land grant permanent fund combined with the pro rata severance tax distribution. The distributions result from not just returns on investment, but also from the inflows to the funds. More on those a little bit later, and perhaps at the next meeting. We've convened a group of the sovereign wealth funds in this country. We started out thinking there were 11 of us. We then decided maybe there were 13, and perhaps there are a couple more. It all depends on how you define a sovereign wealth fund. I like to use the term endowment, and I think that's an appropriate term to use for a sovereign wealth fund. But we all get on the phone each quarter and we share ideas and we ask questions of each other, and it's been very productive.
So it's so it's an informal group. It's not an association that we're a member of. Okay.
We created it.
We created it. Okay.
We created it. There's nothing formal about it.
Okay. All right.
Carrie produces some summary notes for the people that are on the call each quarter, and we each participate in forming the agenda.
Okay. Thank you.
We're also focused on intergenerational equity, and we're going to be looking at the intergenerational equity model that RBK helps Vince and our staff put together. I think you'll find that interesting. That is a key reason for having a sovereign wealth fund or an endowment, as all of us know. Today we will ask the council whether the council would like to endorse one bill, and that is the Tax Stabilization Reserve, sometimes known as the Rainy Day Fund. This is a statute that was put into place last year, was sponsored by Representative Larry Larrañaga, and this will be the first year when that Tax Stabilization Reserve is funded. We're happy to have Dawn here today because Dawn can give us current information about what might be going into that fund. Dawn, can you give us a current estimate?
Welcome, Harold.
Apologize for being late. That traffic out there was really something.
Not a problem. We're getting our briefings right now, sir. Item 2.
Absolutely, I'm happy to give an update. So the Tax Stabilization Reserve had previously existed under prior law, but was never a true rainy day fund, and that's what the Larrañaga bill did do, was create that into a true rainy day fund. There was a point at which any transfers into that fund if they exceeded a certain amount, would then go back out of that fund and be redistributed to taxpayers. What that bill did was take away that provision and allow for additional distributions into the tax stabilization reserve. So there's two mechanisms that the tax stabilization reserve can get funding. The prior mechanism, which was already in statute, was that if the operating reserve, the funding that's captured if revenues exceed appropriations, if that operating reserve exceeds 8% of the prior year appropriations, anything in excess of that would go into the tax stabilization reserve. In FY18, that was the first time in several years that any distributions was made to the tax stabilization reserve through that mechanism. Usually one-time legislation during the session would capture any funding so that the operating reserve would never get to 8%, so that distribution would never be made. But in FY18, revenues came in so strongly at the end of the year after the session had already occurred that we did end up having a huge inflow of money, and about $526 million was deposited into the tax stabilization reserve at the end of FY18 and is sitting in that fund right now. In FY19, the new mechanism through the Larry-Nyaga bill that will allow additional transfers to go into that fund for any funds that are received through the oil and gas school tax that are in excess of the 5-year average of that tax revenue would then be distributed into the tax stabilization reserve. That's a new mechanism, and because we have such a high production now over what we had in the last 5 years, there's an estimate of about $130 million going into that fund in FY19 and a little bit less than that going in FY20. Those will change depending on the revenue estimates, prices, and productions, and how much revenue we do actually receive through the oil and gas school tax. But there is about anywhere between 130 and 150 million expected in FY19. And I'm happy to answer any additional questions on the reserve fund.
Thanks, Don. We'll get to that a little bit further down the agenda. We appreciate that briefing. There is a bill draft in the council materials. Each of you has had a chance to see that, and we'll have a discussion here in a few minutes. The thought is that perhaps if the council were allowed to invest these funds, they could earn more than they currently do, and Vince will be discussing that with us. We had a budget hearing yesterday. It went well. The LFC recommendation was adopted by House Appropriations and Finance. That is $61,206,000. And your staff was satisfied that we believe we can operate within those bounds. Finally, just a comment on where the inflows are coming from. And I think all of you probably know this, but I like to mention it. The severance taxes, which flow to the Severance Tax Permanent Fund, were originally 50% of those that were collected by the state. Today, that number averages about 5%, sometimes not even that. So that number has changed considerably over the years. The inflows to the land grant fund come from oil and gas royalties. Thank you, Commissioner. And those royalties have been extremely helpful over the past year or so and have grown, and we're pleased with the way that that fund is balanced in terms of inflows and distributions. So, Governor, that concludes my comments. And I think Vince may have a few.
Before Vince starts, are there any questions by council members about the briefing from Steve? Mr. Treasurer?
Thank you, Governor. Why the increase on the budget request? I mean, that was better than $6 million over last year.
Treasurer Eichenberg, probably the biggest budget item that we have in the budget is management fees and contractual services. And given the timing of the appropriation request, we are basically projecting asset growth through the end of fiscal year 20. So the asset management fees are what largely drives that request. If we don't need the monies, they're reverted back to the funding source, which is the land grant permanent fund and the severance tax permanent fund.
Thank you. Thank you, Governor.
Any other questions? All right, Vince, you're up.
Thank you, Governor. Well, in your book is the November 2018 performance report. I'll make a few comments about that. Also, we've got an early look at December, and I can tell you a little bit about what you'll be seeing next month in that report. But before we go there, Matthias and I are going to gang up on the biggest question we've gotten since the market sold off, and that is our strategy working? And we've heard that from a lot of different quarters. So I'm going to walk you through sort of where we've been and how we got to where we are. That Matthias is going to show you whether or not it's worked in the risk statistics. So there's two pieces of information. First is an obnoxiously large piece of paper here with a graph on it. And the second one is this green and white report that says effectiveness of strategy to reduce volatility. So Matthias will brief you on that. I'll brief you on this big chart here, and let's start with that. So I tortured the investment committee with this for about 45 minutes at 2 meetings, so they've seen this before. But let me orient everyone that hasn't seen this before a little bit to what you're looking at. So the first thing, of course, is the price chart of the SIC-2019 back to the left recession. So if you look at the left-hand side of the page, you can see the price data starts in March of 2007, peaks out there in October of 2007. There's a big financial crisis, and down about 50% down there after the market went off to the races we go, up to today's activity. And I think that's 2 weeks ago when I updated the chart. So about 2 weeks more data there, and it's higher than it is here. Then there's quite a few boxes with numbers in it. We'll go through those very quickly. I think you'll grasp it very quickly. Down at the bottom of the page is where we were in the economic cycle. Now, as you know, we do the annual investment plan each year, and it's a 7 to 10 year time frame. We talk an awful lot about where are we in the economic cycle, how should the markets be responding, how are we positioned relative to that. We have a lot of discussions on those things. So here's where we were in this cycle in terms of the stages of the economic cycle. Recession is defined by the government, so the break point between late cycle and recession, and then between recession and early cycle is predefined for us. I've got some models that sort of tell me when we've moved from early to mid and when we've moved from mid to late. And I think it was May we did a late cycle report to tell you we think we're moving into late cycle now. Our indicators are saying so. We walked through what that means, has meant historically, and what we think that happened, what we think happens in the markets during late cycle. And actually, we're getting a pretty good play out this time around in terms of late cycle markets. But let's walk through this just very briefly. On the left-hand side, you see a classic V-shaped bear market and recovery. In fact, it's almost too perfect. When you look back at previous recessions and previous market drawdowns, they're not quite this pretty in terms of the V. And then we advance up into 2011 and into a recovery. Then we got the mid-cycle PE run. That's the middle of the page there. That's typical. So in just about every economic cycle, just about every market cycle, you'll see a mid-cycle PE run. What's happening is the economy's growing, earnings are rising at corporations, but investors are putting an ever higher price on those earnings. So we make a lot of money during this period, and you can see the price chart goes up fairly steeply because earnings are going up and investors are putting a higher price on those earnings. And that drives the price of the market. There at the beginning of 2015, we had what I labeled a late cycle head fake. Some of my indicators were starting to turn over and say we might be headed into late cycle here. Timing-wise, it was about right. That period there is about the length of an average economic cycle. We're in an extended one right now. And we had about a 2 year period, almost 2 year period. It was from the beginning of 2015 until November of 2016 when the markets just flat went sideways. In fact, the return for that period, for that 18 months or 22 months was 3% annualized, and 2% of that was dividend yield. So only 1% gain in price for that almost 2 years. The indicators are sort of telling me we were going to late cycle, but weren't quite firm enough. And then the election happened in 2016. It was a surprise to everybody. The market was particularly surprised and really priced in some faster growth for the economy and higher growth for corporate earnings. That's that big steep run you see in the market. In fact, that's 21% from November of 16 through the end of 2018. Since the economy shifted over into late cycle, we went through that with you last May or June, it might have been. And this is really classic late cycle activity. Volatility in the markets, big drawdowns, concerns a lot being raised, and high prices. Now you can tell the price in the market by the box that says Shiller equals and then a number. So if you look at the right-hand side, Shiller equals 33 times. That's very, very high. The average Shiller across all time that goes back to the 1800s, late 1800s, is about 15. During the 1980s, when the market was doing very, very well, and since it's been about 22. Once you get past about 25, and you look forward 10 years, you get, almost every period, you get awful investment returns from the stock market over that forward 10-year period. So you can see the market went down to a Shiller 13 during the great financial crisis, ran up to a 27. From that point forward, historically, you don't get very good returns out of the stock market. About the rate of inflation is the average, and there are periods where you get losses. Now, that's for a 10-year forward-looking period. But what we really want to talk about, what's in those boxes. That's the orientation of what you're looking at here. What we really want to talk about is what's in those boxes. And if you look off to the right-hand side, you can see October 2007. And there's our asset allocation at that time, right before the great financial crisis hit. The column A is the actual allocation.
Left-hand side.
Left-hand side, I'm sorry. Left-hand side. The column A is the actual allocation. The column T is the target. And then CV is the contribution to volatility of each of those asset classes. So as Steve was telling you early on, we had about 85% of the money invested in equity or equity-like things. And if you look at the CV column, 64 plus 16 is 80%, just in domestic equity and international equity, those first two categories. As you go down the list, it's core fixed income, non-core fixed income, absolute return, private equity, real estate, and real return. Now these numbers are a little bit deceptive in the case of real estate. All of that real estate was opportunistic real estate, very highly risky real estate. The private equity is, of course, equity. The non-core fixed income has CDO equity in it, so very equity-like security. So upwards of 85% of the volatility, expected volatility of this portfolio was just due to the equity market. And it hurt when we went into that minus 50 market of the great financial crisis. Now we came out, you can see in June of 2011, that's that kind of correction to the or recovery of the GFC. You can see the asset allocation at that time. Some equity was pulled back and redistributed to the other asset classes, but that's a very slow process to move money from that public sector to the private sector. Now, right at the top, you can see a line that says ERA, that's expected return, arithmetic, or average annual per year, and then expected return geometric, which is our long-run compounded return. Keep an eye on those numbers, because as we go across the page in these boxes, you're going to see they actually rise. So while we took a very risky portfolio, a very risky position with the equity markets in October of 2007, and we've really diversified that risk into these other asset classes, we haven't lost future expected rates of return. That's been the key to being able to diversify some of that risk. Markets valued up into 2011. The council did an asset study. We changed the allocations to the T column. So you can see U.S. equity or domestic equity, DE, went from 53% target to a 31% target. We raised international equity a little bit, and then you can see how the other targets have changed relative to October 2007. We went on the mid-cycle PE run. That started to stall out in 2014. We did another asset study, and as you can see there, Shiller 27 times. U.S. equity is expensive here in June of 2014, so the council takes down the allocation to U.S. equity again. So we go from 31 to 22% between June of 2011 and June 2014. Redistribute that to the more stable asset classes. As Steve mentioned, more income-producing assets. We get this sort of late cycle head fake, and then boom, up goes the market post-election to very high levels of valuation. You can see Shiller 33 times. The only time the Shiller's been above 33 was in 1929, right before the crash that wiped out 80% of the market value, and right before 2007, or right before 2000, where the market wiped out, a little over 50% of its valuation. So the only time the market's been over a shiller 33. And we know, looking back in history, forward 10-year returns out of U.S. equities are pretty poor once you get above 25. So the council does another asset study, and we take down U.S. equity or domestic equity to 20%. That's the box labeled June 2017. It was 30 shiller at that time. We've risen to 33 now. So in total, we've moved from 53% in U.S. equity to 20 as a target, and contribution of volatility from equity has gone from 80% to just a little bit over 50%. We've really diversified the portfolio away from equities. We've been really diversified it away from the U.S. equity. Again, keep your eye on that in particular, the ERG line, the expected return geometric. That's gone from 622 in October 2007 to a 670 in June of 2013. So we actually have a portfolio that we think will earn 50 basis points a year, compounded more than the one in October of 2007, with a lot more diversification from the equity market. So that's where we've been, and kind of in a nutshell. I'll take any questions on this chart, and after that, I can turn to Matthias and he can show you did it work. And he's got some real good numbers in the green package.
Okay, Vince, do we have any questions from council members?
Maybe just a comment, Governor. I think that we had asked Vince, the fun thing about charts is to take them and try to cover up this end of it, try to figure out where it's going to go. So we've asked Vince for the next investment committee meeting to tell us what happens on this stuff.
Mr. Harold, good advice. Good question. Thank you, Harold. Guys?
Thank you very much, and thanks, Vince, for the intro. I think everyone should have a separate handout that is titled Effectiveness of Strategy to Reduce Volatility. This is really a continuation of some of the insight that Vince just shared with you all. And at this point, probably not a surprise to most that the fourth quarter ended with a fair amount of pain. We saw volatility make a roaring comeback as some of the ongoing issues, whether it's rising trade tensions, interest rate risk, things of that nature, a little bit of softening economic data came back and really weighed on global economic markets. So we saw that come through, and as part of that, this was highly expected, certainly by the SIC and by this group in particular. So we've been working on a strategy for a number of years to prepare for precisely this type of environment, and we wanted to come back and show you whether the work that's been done has been working. And I know that Linda specifically asked for a more in-depth report on this, so it's also in response to that.
As you're going, and given that we're expected turmoil in a variety of ways in this environment, is there an analysis of the federal government shutdown's impact now on investment strategies, rates of return, market volatility, Wall Street?
These types of events are incorporated into our annual capital market assumptions that we develop, and those will actually be finalized by the end of the month. So that's where that comes into, and then influences the expected return on risk on those various assets.
So those models are. Senator Jennings has a question or comment.
It's good information, but is there any particular reason why this isn't being webcast?
Probably this is what?
It's not being webcast. Had somebody here webcasting everything, and now we don't have it. And I mean, this would be good information for me, for the general public to see.
Yeah, I have a partial answer, and Charles as well. The quality of that webcasting up here and some other issues, we're trying to get them addressed. So we'll go back to that, and we're going to do audio larger so people can actually listen in and get clear information. It's really fuzzy and hard, so we are not moving away from transparency. We're trying to deal with some of the technical issues so that we can broaden transparency. But that's a good question, Senator. I'm glad that you raised it. Charles, am I missing anything about that, or Charlie?
Governor, that's right on point. It's just we're addressing some long-term issues with that, and hopefully we'll make it better and more accessible to the public.
And sooner rather than later. And so for the general public who's trying to figure that out, as we've got some audio stuff going on, we are getting that done in short order, because we should have this information available. And also, Senator, I'll jump the agenda. I'm going to, in new business, talk about ways we can engage the general public and create a better opportunity for digesting this complex information so that people really know what we're doing and how we're doing it and how we're basing those decisions and recommendations. So I really appreciate the timeliness of that comment. Scott?
It may be worthwhile, Charles, to put some sort of little note on our webpage for those people that follow that to tell them why this wasn't broadcast, just to answer that question for the public.
Good point, Scott.
We'll do it, Scott.
Can we do that? Thank you. Thank you, Senator.
With that, maybe before we dig into some of the actual data, on page 2, you'll find a few high-level risk management principles that may be worth reviewing just quickly. And the goal of risk management, certainly at the total fund level as we see it, is not to eliminate risk entirely, but rather to have outcomes that fall within the range of expected consequences at the decision point. So when we do the analysis, is it a type of analysis, and is it a decision point that is expected over time? And so we recognize that you have to take on some risk to earn a return, but we want to make sure that those risks are well understood, they're properly compensated, and in line with expectations. Many of those risks we try to measure, although effective risk management is not just done by measuring the risk. Oftentimes it takes more of a qualitative overlay on top of that, and so the risk numbers that we have serve as a reasonable foundation that really allow us to compare one decision over another and see some of the trade-offs and the implications, but it still takes a fair amount of qualitative overlay and making sure that some of the intangibles are captured. And Vince does a great job on the annual investment plan, tying into this type of analysis all the other ancillary risks, and I'll highlight those in a little bit, what those are. And some of those are liquidity risk, things of that nature that are not as easily measured. Although Vince has done a great job trying to quantify that and incorporate it into the asset allocation. I think we'll be back this spring with another review of that type of work. And so I mentioned it time and time again, but especially for those that are new to this council, our research really indicates that you don't have to be in the top quartile or in the top decile to be a long-term top performer. Really, all you have to do is be consistently above median or at median. The key word there really being consistently. And so as much as you're able to reduce the volatility in terms of your ranking and your relative returns, the better it is for the long term. So you have to take a long-term view and be happy with singles at times and not always try to hit home runs. I think that was an old strategy that, and again, we'll look through that really didn't work, and we'll try to highlight how this new strategy has likely been more successful. On page 3, and some of this Vince already mentioned, is that over time the target allocation has evolved, and it's evolved for a number of different reasons, primarily to account for the changing market environment. And as part of that, we've seen a much broader diversification, particularly on a thematic basis. So before, when you had a portfolio, and you can see the various portfolios, they should coincide with the other handout that Vince provided, for time periods that span the past decade. Going back as far as 2007, you'll notice that domestic equity made up more than half of the portfolio. So it was a very equity-centric portfolio, and really the performance was a result of the public equity markets. If the public equity markets performed well, you did really well. But if they didn't, well, you didn't do well. And so it was very much a violent swing in both directions. And again, as part of our research indicates, these violent swings really don't contribute to long-term strong performance. So this effort over time, as you'll notice there, it has been to diversify not only the risk but also the return sources. When you look at these allocations, you'll notice that as you go from the purple over towards the green, you see a much more balanced allocation to some of these asset classes. So it's a much more measured and prudent approach to getting access and exposure to the capital markets.
Just one point, you'll see on the international or the non-U.S. equity, that goes up. again, that was a diversification. You were restricted for how much you could put in non-U.S. equities, and as that changed, you were able to diversify your public equities more by putting not all of that in domestic.
There was a statutory change.
Yeah.
So for this type of analysis, and oftentimes I think in this industry, volatility is used synonymously with risk, and I think that's a little bit short-sighted. There's lots of other risks, but it's one way to measure risk. In this particular analysis here for page 4, what we're trying to highlight is that not all asset classes contribute equally to overall volatility on the portfolio. Again, we know that equity tends to have a disproportionate contribution to overall volatility, which makes it all the more important to try to right-size those types of exposures. Particularly when the capital markets are as richly valued as they currently are. Now, publicly traded equity remains the single largest source, and I think that would be hard to diversify away, but you've reduced it materially, and certainly more so than before. You'll see in 2007, you've had publicly traded equity. The contribution to volatility was almost 80%. As of 2017, that's down to about half. So a meaningful reduction.
Right before we leave this page, Marcia mentioned that on international equity, you've seen that go up. But we did have a limitation there. But from the other page that you saw, the U.S. markets all markets around the world are fairly expensive today. But the U.S. markets at a 33 shiller are very expensive. These international equity markets are about half that valuation. They're about a 16 or 17 shiller. So for every dollar of earnings these international companies make, the market only expects us to pay 50 cents relative to what we have to pay for U.S. earnings. So moving money into the international markets is a way to lower our risks in terms of valuation.
On the next page, page 5, and again, as I just mentioned, we know that publicly traded equity is one of the biggest sources of portfolio volatility. So to the degree that sensitivity to the public equity markets can be reduced, the volatility in the portfolio can be reduced. And one way to measure that is equity beta. It essentially measures the sensitivity to a public equity index. And there what we try to do is bring that number down over time without materially affecting the expected geometric or compound return. That's the ultimate goal here. And you can look at, if you focus your attention on that top box, you'll see the equity beta for the trailing periods, and you'll notice that the 10 years is 0.57 all the way to the right, and as you scan towards the left-hand side of that page to the more near-term time periods, you'll see that there has been a steady decline. The bottom half of that page shows that on a rolling 3-year basis, you can see the trend line has been down as well.
So when will we be? Does this outlook change much when you're looking at 2018, and when are those numbers available?
Those numbers will be available at the end of the month, and we will come back in the spring with the implications to the portfolio. For equity beta, that's something that we look at and we measure, and we try to ensure that it's moving in the right direction, but it's not necessarily a primary driver of the decision making in terms of the asset allocation necessarily. It's sort of more of a check after the fact. But we recognize that some asset classes will have a higher equity beta than others, and there's been certainly a focus on getting some of the lower equity beta asset classes in the portfolio, particularly those that generate higher levels of income. Because again, that's a way to reduce the volatility. If you're not, when valuations are as rich as they are, having a lower focus, lower emphasis on capital appreciation and more on income provides some stability to the portfolio. On page 6, you might say, well, that equity beta reducing is just a byproduct of the markets, and you wouldn't actually be wrong. I think that's certainly one of the contributors of just the market dynamics of lower beta in the actual market, but another way to measure this is relative to peers, and peers all have the same opportunity set and can make changes just like you can to your asset allocation. And you'll notice here, so now this sort of puts it on the same playing field. You'll notice that On the right-hand side, within the green box, you're in the bottom quartile, which in this case, bottom quartile is the best. So you have relative to your peer funds, other institutions with similar scale and resources have substantially more volatility than you do. So irrespective of what the market has done, you've really moved towards the top. If you go beyond that, if you go further back, and again, these are 3-year rolling, so the time point of, let's say, 2013 really captures 2010 through 2013. So it's a little bit backward looking, but before that, you can see you were on the other end, so you had a fair amount of volatility really on the other end, and that was one thing that I know collectively we've all worked diligently to reduce. So that's been working. Now this is all great, but what does it mean in terms of actual numbers for the total fund? And so that information you'll see on page 7. We've provided this two snapshots. One as of June 30th, 2014. That's one of the more recent target allocations that is identified in some of the other materials, and then as of third quarter 2018. And these charts should look familiar to most, although we've amended this a little bit, and I know we've highlighted it verbally, but I wanted to show it to you in writing here as well. And maybe we'll just focus on the top 2 boxes and compare the 5-year period and what has transpired over that 4-year period from 2014 to 2018. And there what you can see is that just in this short time span, and again, that's 5 years back from that date, you can see that the land grant total fund, for example, captured 101% of the median return and 107% of the risk. And just over that 4-year time span, if you go to the right-hand side of that period, has gone the other way, where now you're capturing 101, so similar amount of return capture, but with 87% of the risk. So you're capturing just as much, if not a little bit more return than what your peers are capturing, but with about 10 to 15% less volatility, less risk. So directionally, you've really moved in the right trajectory, and we continue to see that going forward. If you compare that then down to the 10-year period, looking back even further, you'll see that that's true even more so. Where historically you would have more risk than the peer fund and less return, now you're actually getting the same or more return for substantially less risk. That's really where you want to be.
For the rest of you who are as visually challenged as I am, the green button is hidden under the blue button on the right-hand side. They're really almost overlapping.
And the same with the policy for the orange and yellow.
Yeah, and ideally where you'd like to be is in the top left box, because that's more return with less risk. Where the 2 red lines intersect, that's the median. And all the other gray dots are just a scatter plot of all the other funds in this universe. So again, when you're in the, I would say, the bottom right, that's the least optimal place to be, because you've got less return and more risk. And as you're moving towards the top left, that's really where you want to be, and that's exactly what's been happening. As you compare the 10-year to the 5-year, so you can see that movement up.
And before we leave this chart, Matthias, particularly in this portion of the economic cycle where we're late, we've got high valuations. The further to the left we are, the better. Now, we get back in that early cycle, like you saw on the previous chart, we could take those dots and move a little further to the right. We'd still like to be above the line, but to take a little bit more volatility relative to peers when returns are looking like they'll be good. But right now, when things are as rich as they are and we're as late in the cycle, we want to be on that left-hand side of that box.
We're nearing the end. Page 8. This is one measure. I think the Sharpe ratio is one that most have probably heard of. And really, all it tries to do is quantify the return and the risk in a single metric. And you can see on the very far right-hand side, if you focus on the top, you have the Sharpe ratio relative to peers. you'll notice that the total fund composites of the actual assets are in the top quartile, 19th percentile, and the policy index, the long term, so the allocation that we're working to implement, what we're moving towards, essentially our target is in the 11th percentile, so almost top decile. So that is very, very good. You're really squeezing the most amount of return out of each unit of risk.
So again, those numbers in the brackets are the ranks. You can also see it on the floating bar charts above by the quartiles.
These percentiles can be a little bit confusing, but I think you've got almost 400 funds in the all-fund database. So what that means is the policy or land grant composite in the 19th percentile means there's only, out of those 400 funds, there's only about 100 funds that have a better, there's only about, less than that. Right, there's about 40 funds that have a better Sharpe ratio than we do out of 400.
On page 9, this is, I think, testament to what we had mentioned earlier, and this is in your quarterly performance deliverables as well. You see that as you look on the left-hand side of that particular page, your ranks, and this is on the total fund, on all the assets, was either at the top or the bottom, and it would be very episodic and oscillate from one period to the other. And again, that was primarily a byproduct of the equity markets. When they were doing well, the fund ranked great, and vice versa. And you see, as you've moved to the right-hand side, there's been a real diligent effort to try and provide a more narrow distribution of outcomes, so that the consequences are more closely scattered around really what we're trying to do, and have less volatility on the relative ranking. And this is on a rolling 3-year basis. So again, if we can be in the top half and not really avoid the bottom consistently, then the long-term ranks, particularly over the longer time periods, will improve. And that's exactly what's been happening as we've been monitoring the relative ranks. They've continued to march up and improve because of that, particularly in environments where you have more volatility and some drawdowns, because you have some protection built into that. There's a lot of the other peer funds that we look at collectively that are very, very risk on, very, very public equity centric, and they've done quite well over the last 7 to 10 years since the recovery. But it's been a rising tide for essentially all funds. It'll be really interesting to see when we get the December numbers through with this fourth quarter of more pain that's actually registered. We'll see what that does. But it's certainly the environment, I think, that will continue to serve this council very well, because it's prepared and it's been thoughtful in the way it's designed it. And I think that will only help the ranks.
This is really important, the consistency that Matthias talked about on the first page. We started looking at this when our clients would say, okay, what fund is at the top here? And why are they there? So we did this analysis, and it was for a fund in New Mexico, and we started doing this, was looking at, okay, this fund performed really well this year. What did it look like years prior? And we're able to do that. Now, we didn't show names of the funds, we showed a number. And more often than not, again, if you're taking risks to get that top percentile, you're going to go through a market environment where you're going to lose. Just taking that volatility, which is what this whole presentation is about, and diversifying so you don't have those peaks and valleys. I can't state enough how taking out that volatility really gives you longer term stable numbers, and you've achieved that going through your asset allocation changes. So consistency and less volatility is so important.
I'll try to wrap up here in just a
Yes, I'm sorry, Senator.
Yeah, thank you. I'm just curious, as we tend to pick the land grant permanent fund because as a comparison, because we get a little bit of return and then we'll do the severance tax. But it would be interesting to see where we were if we used total assets under management given that some of the different funds have different restrictions, but also I'm imagining that some of the funds that you've got here as peers would be the ERA and the PERA. And it would be interesting to see, since the legislature and the executive probably, we're constantly somewhat compared to them, it would be interesting to know where they are, if they are part of the peers on here. At least, probably not that scattergram, but some of the others, because that's what the LFC, EFA, and others might be looking at. How are we doing compared to them, not just how are we doing to the global group. So I just, down the road, if you could put that in there, I think it'd be an interesting.
Since you've done that with the Black Dot.
We've talked a little bit about it. I've got another analysis that shows we run 36 or 35 funds, asset allocations through RVK's assumptions, and plot them on a scatter plot, return on the y-axis and risk on the x-axis, and it just plots everybody out basically what everyone's expecting going forward. We plot out very well on that. You've seen near the top. Parent ERB have a little bit more fixed income in their portfolio, so they're back to risk scale a little bit, and expected returns a little bit lower for their funds. But I'll bring the Black Dot chart for you next time.
And also, I think it's important to look at when we look at those and compare, because other states have said the same thing. We want to know what our sister funds are doing. When we've done that, it's very important to talk about what the objective of each of those funds are, because most of those funds are retirement plans, unlike your funds. So.
But we are by policymakers compared to.
I know you are.
So it's important for us to be able to defend, where we are and why we're there.
So we'll get that done based on that comment. So for the next meeting, we'll be able to. Is that enough time to plot that out?
We can review that Black Dot chart, Governor.
Great. Okay. Thank you, Senator.
Wouldn't it be real important though for all of us to know on PERA and ERB about where they come up? I mean, to me, I think you almost have an obligation to look at that, because one way or the other, we're going to be liable for the shortfalls in ERB and PERA in the long run. I know we don't run them, that's true, but I think we should look at it. We should have some awareness about where they are and where we are. I mean, we're going to be liable for them. Where are they going to look to get the money? If those funds aren't solvent, where are they going to look to get the money? I mean, chances are politically, one of the first places they'll come to here, because we got it. I mean, it's the way it is with everything else.
No one ever wants to hear from a lawyer. When I hear liability, I sort of raise up. I think that's liability. Senator Jennings means that as a taxpayer matter. How is the state going to handle underfunding and beneficiary distributions at those pension funds? The SIC is not liable for the pension funds. I suppose it's a potential source of capital for the state, but...
Which was his point exactly. But have no trouble with your clarification.
People are listening.
In the broadest term in which you talk about rates of return and how those work, in the broadest sense, all assets of New Mexico are tied one to the other when we're looking for places. In fact, someone I should remember who made the point about what the taxpayer liability would be if we asked taxpayers to be liable for any of these issues. We are not in this meeting, have not, and are not currently.
And as your counsel, you as board members are not liable for that situation.
Although I would be happy to make a motion that Tim would be.
I didn't say one major short joke.
Thank you, Senator, and thank you for that clarification, Evan. It's important because people can't really, and we want to make sure the context is clear. Thank you. Okay, any other discussion about where we are so far in this handout? Am I missing anyone? Okay. Matthias, I didn't get your name right.
Yeah.
Thank you.
On page 10, I'll just point out that you'll see the expected tail loss, and really all that means is what we've done is modeled the 2008-2009 type of environment if there was a substantial drawdown in the capital markets, what would the implications be? And again, the top left box, you can see that under the allocation in 2015, the portfolio would have stood to lose about 31%. Today, with some of the changes to the target allocation, that's been reduced to 25. So that's a 6% better downside protection relative to what it was even just 3+ years ago. So that is quite meaningful, particularly in the worst type of scenario that we also plan for. So the last page that I'll cover is page 11, and this is that case study that I highlighted at the very onset. How did this work in the fourth quarter in October, and we saw some of this volatility coming through? You'll see that there's 2 bars for each of the groupings down below. The Russell 3000, which essentially represents the U.S. equity market in aggregate. You see that in October was down 7.4% for that fourth quarter. That's the second bar in totality, down 14.3%. So a double-digit decline. Under the 2010 target allocation, and I'll just focus on the fourth quarter, the portfolio would have lost 6% under that allocation in the fourth quarter. Under the 2015 target, 5%, and under the current most recent target, 4.9%. So you can see that there's been progressively more downside protection built into this portfolio. And so certainly under this type of environment, the first more recent environment that really put this to the test, I would say that it passed and performed in line with expectations.
So Matthias, the answer to the question is it worked.
It does. In short, yes. I could have just said that and stopped the presentation.
No, but Linda wanted to see proof of it, so that's why we put this together.
Governor, I don't think we can emphasize this. In my opinion, we can't emphasize this too much. And that is that, when we set out some years ago, when the council made a decision that we were going to try to build the portfolio in such a way that we would capture a reasonable amount of the up and hopefully less of the down. And that's really what this shows, is that that's what we've been able to do. And I think we have to emphasize that part, because there have been some criticism from time to time when the equity markets were screaming, because we weren't making as much as those markets. But look what's happening, just this one little down push. And the fact that this is critically important for us. This has been our goal right here.
Thank you, Harold. Any other comments about the presentation? Any other questions? Yes.
I really like your chart on page 6. We hadn't seen that chart before, and I thought that was a very revealing chart to show how really tightly clustered we are in
That's right.
the low volatility.
Right.
That was great. Thank you for this report.
Thanks for the suggestion.
It helps me get verified, doesn't it?
Yes, it does.
Thank you, Linda. Deus, all right, anybody else? All right, seeing no other comments or questions, we are going to move on to the rest of the agenda. I'm actually going to step out as we have the investment committee report, which we're going to have by Linda. I'm going to defer to the vice chair, Peter Frank, who will continue the meeting, and I'll be back in about 15 minutes or so. You might end up moving through if you need me, but we've got a quorum. I'll step right back in. Okay. We good?
Yes, thank you.
All right, Peter, thank you.
Okay,
Linda,
so
you're up.
Linda, please. Peter, do you want the November performance report?
Yes, why don't we do that, Vince?
Just very quickly, if you go to page 16 in your packet materials, that's normally where we start. I'm sorry, page 17. There it is. Page 17 in your materials. We normally start in that upper right-hand box to show your asset allocation relative to your targets. We're a little out of round with core fixed income. It's 5.18 percentage points above the target. Our limit there is 5. Policy just says if we get above a limit, then we get it back in a reasonable amount of time. So we're not forced to sell to get back into policy limits. Bart's working diligently on non-core fixed income investments, and we should be shifting some capital, and I would expect over the next 2-3 months you'll see that come back within specs for the fixed income portfolio. Everything else is quite close. A percentage point or 2 counts as quite close. Our limits on most of these by policy are 4 or 5%, depending on the asset class. Severance tax, quite a bit closer, just 3 percentage points for core, over on core fixed, and roughly that under on non-core. So you're within policy specs, except in the land grant, and like I say, we expect to get that fixed here in the next few months. Part of moving this portfolio away from equity and away from volatility into other things is also not only just to reduce risk, but to enhance our returns. And you can see at the bottom of the page there, relative to the benchmarks, we've done just that. So if you look historically, there's lots of red, there would be quite a few red numbers in the difference line. Today we are in the black, ahead of benchmark straight across the board, just barely in 5 years. But we've got some tough performance that happened right at the end of that, or right at the start of that 5-year period that'll be rolling out. So we'll expect to see that 5-year number come up. Keep in mind that's in basis points, so as a portion of that's in percentage points there. So multiply those numbers by $25 billion roughly, and that's the excess return in dollars that we're bringing into the portfolio. Both land and severance, of course, ahead of benchmarks. You can see across all time frames now. If you flip over to 19, this is a breakdown by asset class. Probably one of the biggest things that we did on to reduce equity volatility, not only taking money out of U.S. equities, but also structuring the U.S. equity portfolio to try to keep up in those up markets, but outperform in the down markets. So if you look at your quarter-to-date number, which is a very short period, just 2 months, you can get an idea. It was a rough 2 months, so you can get an idea of how that U.S. equity portfolio performed. It was down 4.93%. The markets were down 5.51. We outperformed by 58 basis points. In the U.S. equity markets, 58 basis points is a lot. So that portfolio really did what we expected it to do, about a low 90% capture rate in an underperforming or a down market. We had a good month also in December on a relative basis. So when you see the December report, you'll see an even bigger number than that for the full quarter in terms of outperformance. I think that was all the comments I had on this. December came in, we were down for the year about 1.5%. We were expecting closer to 1. The main difference between the 1 or so that we were expecting down 1.5, a lot of that resided in the MLP portfolio. It was down about 20% for that downdraft period. Now, we've gotten about 60 or 70% of that back here in January. That portfolio has been more volatile than we expected and more tied to the price of energy than we expected. So we're looking at that. We still think it's a good investment. The other two agencies, by the way, did too. They both have MLP portfolios in their asset mix. Because it was very attractive when we bought it. Those assets are very attractive. It's primarily, as I think I heard Lee saying, oil and gas pipelines. They're long-term take-or-pay contracts, so
good income.
Yeah, so very good underlying, very stable assets. It's the security, it's the MLP security itself that's so volatile. The operations are very stable and long-term in nature and throw off a lot of cash.
So the December numbers that you just spoke of would not have updates on private equity?
Well, it's the JP Morgan report. That's an early look. Yeah. It'll be within a few basis points of that, even though those numbers come in.
Vince, comment on the income component of MLPs.
It's most of the return is over the long run is income. So those things yield right now 6 or 7%. And that's in a market where the 10-year Treasury yields less than 3. So very good income component out of those assets. But the price here has been volatile, more than we expected when we first made that investment. So that's all the comments I had on this. Peter, I don't know if Matthias wants to add anything.
Okay, would you take us to Paul? I guess Paul and Townsend will do the areas one for us, please. Deal with Portland. Oh, I'm sorry. Go ahead. I got off stride.
Okay, first of all, I'd like us to go back to this report that Vince was just going over. And on page R17, where it goes through the difference in the policy versus what we are achieving, that's a difficult number to do. And the consistent overachievement is something that we really need to give credit to Vince and his team for. That's what we strive for. And Vince, would you actually put a dollar figure on it for us for the outperformance of the policy?
Well, land grant is, in this report, $17.4 billion. So you can multiply that number, $17.4 billion by 0.46, and that will get you a dollar figure.
And that's how much your overperformance has given us.
That's right.
So that's remarkable. We really need to acknowledge these superior performances. Another thing that we're seeing coming out in these reports, page 22. Let's go to 22 of our materials. That's the 3-year performance figures, and we're actually seeing manager outperformance. And that is terrific because it's very hard to get manager outperformance, and we can see where that manager outperformance has come. As we all know, almost all of our performance is attributable to asset allocation. But then when you get this extra bump coming from your manager selection, that is what we strive for. So we're seeing much happening from what we have been striving to do. A lot is coming to fruition. During the meeting, we also spent some time on that very interesting report that Vince gave us today with a large chart. And once again, we always appreciate that information. We also looked at the Ares investment that is coming before us today. We had some questions regarding terms and format of the investment, and we felt that those questions were well answered, and it was a unanimous vote to bring this before the SIC for approval. Also, when Starla comes to her presentation, please look at her materials and see too how she has absolutely outperformed what we had expected in the international public equity sector. And we need to give kudos to her for her excellent performance when we look at her presentation. And that covers most of what we covered in the investment.
And Linda, just so you know, that outperformance in terms of dollars is about $80 million.
Thank you.
Paul? Yes, good morning. I'm Paul Chapman, Director of Real Estate and Real Return for the SIC. For the benefit of you that are new to the council, Vince has 4 directors that report to him. Starla over here, who will be speaking a little bit, runs our public equity portfolio. David Lee over here runs our private equity portfolio. Let's see, Bart Stuckey's fixed income, and I run real estate and real return, along with Clay Camper, who's over on the side of the wall. Real estate and real return portfolios each have an allocation of 12% of the total fund. All of our real estate and real return investing is done through commingled funds. That is, capitals from several institutions are blended together and invested by the general partner. In this case, it's the Ares management team. In the real estate portfolio, we invest in funds that target all major property types: office, industrial, multifamily, retail, but also more specialized segments of real estate like student housing, medical, lab space, elder care, and storage. Most of our investments in our real estate portfolio are in the U.S., but we do have exposure in Europe and Asia as well. In the real return portfolio, there's actually 2 buckets. We have a real asset portfolio, which is roughly 80% of the 12%, and that's timber, energy, agriculture, and infrastructure. And we have a 20% financial asset bucket, which can be invested in things like MLPs that Vince mentioned, Treasury inflation-protected securities, and real estate debt, real asset debt, and things like that. It is in this financial asset subsector of the real return portfolio that the Ares investment will be held. So for investing in my areas, real estate, real return, we have two consultants, Pavilion. So we have Alan over there. He handles our upstream energy investments, and most everything else is handled by our consultants, Townsend, Seth Marcus, and Jack Cope. So staff in Townsend recommend a $75 million commitment to the Ares Real Estate Enhanced Income Fund, which is an open-end fund that will invest primarily in commercial senior mezzanine floating rate debt, targeting net returns of 7 to 8%. These investments are consistent with the income-generating themes set forth in our broad portfolio investment strategy. Ares is an existing manager for New Mexico. We have Ares Real Estate Fund, Ares European Real Estate Fund 4 and 5, with commitments of $75 million and 75 million euros respectively through those vehicles. We recommend this investment for the following reasons. Ares will pursue lower risk investments, which we believe is timely in a late cycle environment. The strategy will lend against well-leased or light transitional commercial real estate located in major markets, targeting loans to value of 70% or less, which means that if the asset values fall by 30%, we are still somewhat protected. As a predominantly floating rate portfolio, the investment is aligned with the inflation-adjusted real return target benchmark, and Ares has a very strong platform with 20 professionals that have deployed over $5 billion since 2004. An investment in the Ares Real Estate Enhanced Income Fund of $75 million is consistent with the real return investment policy constraints and objectives. Subsequent to this investment, the real return portfolio and the financial assets suballocation will remain in compliance with all policy statement requirements relating to portfolio construction, including sector allocation, manager diversification, and international exposure and leverage. So typically we hand it over to Townsend for their views on the investment, and then we'll have the manager cover their materials as well. Seth.
Thanks, Paul. Thanks for your time today. So again, it's Seth Marcus from the Townsend Group. I'll talk specifically about Ares today. Next month when we're here, we'll likely have a full performance review on both the real estate and the real assets portfolio. So that will be coming your way likely in February. So although this is a new strategy for the SIC, as Paul mentions, Ares is an existing manager within the real estate portfolio with the 2 commitments made to European equity funds. Additionally, there's multiple private equity vehicles that the SIC is invested with Ares as well. So this commitment is considered outside the real estate investment pacing plan. So we talked a lot about in the fourth quarter about our investment pacing for real estate. That capital was fully committed. 2019 capital was fully committed in the fourth quarter of last year. This is outside of real estate, as Paul mentioned, so this is not part of that real estate investment pacing plan. But as you may recall, in October we made a $75 million commitment to Brookfield Senior Mezz Real Estate Fund, also an open-ended fund, debt fund, and alongside Ares, this commitment, Brookfield and Ares will serve as the financial assets portfolio along with the MLPs. So as mentioned in the materials, Ares is a new open-ended debt fund related to seek construct a diversified portfolio of first mortgage debt investments producing durable income streams, stabilized high-quality assets, institutional-grade real estate located in major U.S. markets. So Ares as a platform has been investing in this strategy and in these markets previously, and really has a strong knowledge and relationships within these markets. The fund will focus on strong current income and seek to design a portfolio that will produce similar returns to core equity in that 7 to 8% net return range. The majority of these loans will be in traditional property types, so we're talking office, multifamily, industrial, and retail. Although it is anticipated that up to 20% can be in other sectors, and we call others as non-traditional sectors such as senior housing, self-storage, student housing. It is anticipated the loans that we will be making are 2 to 3 years in term, with a face value ranging from 10 to 150 million. That's a large range, but really averaging about 50 million in size. As mentioned, this is a newly launched open-ended fund. Therefore, there was no existing portfolio or assets when we underwrote this initially. There are a handful today that Ares has committed to, and they can speak directly to those during their presentation. So they are starting to build a portfolio and have a deep pipeline as well. Given that the SIC is committing to a new structure, a new fund, and at inception, you will benefit from a 20 basis point fee discount. So at $75 million, the blended fee on this would be 92 basis points is the typical rate, and we will be paying 72 basis points, and that's in perpetuity. Also typical with the founding investor in an open-ended product, there is a 2-year lockup in this open-ended fund before quarterly liquidity is potentially available. As always, in our materials, we've highlighted a number of comparative advantages, some potential issues and concerns which we think are well mitigated. I'm not going to go through each of those. I'll just mention, again, that this is a new strategy and a relatively new senior team member with Jamie who can go through his background. But this is not a new strategy for the Ares organization. So Ares has a deep team and strong track record in this space. They've been a leading investor in floating rate commercial mortgages with approximately a 50-person U.S. real estate team and 30 or 20 of those people dedicated specifically to debt investments. Senior leadership has over 30 years of average experience and a demonstrated performance across approximately $5 billion of originations without a loss of principal. Now, the team is further complemented and supported by the Ares broader in-house research and as well as their credit team, which has over $90 billion in assets under management, and the private equity team and businesses. All of this contributes industry knowledge, financial and corporate experience, and enhance the team's execution in the fund strategy. Lastly, as an investor in this fund, you will receive access to this entire team at that low fee I previously discussed. And I'll wrap up my comments there, but I will mention that Townsend has approved this at our investment committee on a standalone basis for you all, and as well as a portfolio construction, portfolio fit for the SIC. So with that said, I'll hand it over to Julie Solomon and Jamie Henderson to walk through their materials.
Great, thank you, Lisa. Thank you, Paul. I'm Julie Solomon. I'm a partner in the Ares Real Estate Group. I've been in the private investments industry for about 20 years now, and with the real estate group for about 13 years, and I'm delighted to be here with Jamie, who heads our global real estate debt business and brings a 20-year career in real estate, and before that was an officer in the U.S. Navy. And so we are thrilled to have Jamie present more on the strategy today. First and foremost, on behalf of all of my partners at Ares Management, I want to thank you for your support. Our organizations have shared a relationship for many, many years now. You have entrusted us with an incredible responsibility, and we work day in and day out to make sure we are meeting those performance objectives that we've set out. So thank you on behalf of my partners and colleagues at Ares. For those of you who are newer to the Ares organization, Ares is a $125 billion alternative asset manager. We have 3 distinct but complementary businesses in credit, in private equity, and in real estate. And as Seth mentioned, we created these 3 business lines such that each could benefit from each other and bring tremendous benefits to our investors. We believe that our greatest assets at our firm are our people. Our greatest strength is the culture that makes all of our people work so effectively together, and that is how we're able to build out strategies that we're going to talk about today. So what we will spend the bulk of our time on is talking about the Ares Real Estate Enhanced Income Fund. While Seth had mentioned this is a first-time fund structure, it is built upon many years of investing by Jamie and his team and on a track record within the Ares Real Estate business, which has been in existence for many years now. The fund is up and running. We have been fortunate to attract a wide range of real blue chip investors who are seeking durable cash flows in this environment that we're in today. And with the investors that have already come into the fund, we have started to invest that capital, which will demonstrate visibility into the portfolio over time. We're also going to spend the time today talking about what we think is compelling about the structure, which is open-ended and provides liquidity for investors on a quarterly basis. What I'd like to do now is turn it over to Jamie, who's going to talk more with you about the strategy, about why we believe this is the right strategy for this environment and over the long term, and how we are able to execute on the strategy with the team that we have in place. Jamie.
Thank you, Julie. Good morning, and thank you to the members of the council. Also want to thank Vince and Matthias for a great prologue, because I think it speaks to the design of our fund. When you're designing funds, there's kind of an 18 to 24 month lead time where you have to devise a strategy that meets the market and also plays to the organization's strengths. So when we sat down close to 2 years ago and decided what our next fund strategy was going to be, we decided to come out with a core, first mortgage only, open-end fund. And that's That's not a very typical approach to life, but it was very deliberate. And the reasons why we came to that conclusion is we looked at, the future. Once again, a couple years back, we saw really high asset valuations, the potential for increased volatility, rising rate environment, and the potential for a recession. So given those variables, we wanted to bring to market a strategy that was really durable. And we think that first mortgages only, floating rate only, does a lot for institutional investors. Number one, it's designed to protect capital. So that's really first and foremost, is protect capital. Number two, generate high current income. Number three, be positively indexed to rising rate environment and inflation. And number four, avoid volatility and break correlations with the other elements of your portfolio. We think this fund is unique in its simplicity. As I mentioned, it's first mortgages only, and when you think of a first mortgage, it's no different than the mortgage you may have on your house. These are generally, 70% loan to value, first priority liens, which means they have an absolute first claim on the real estate. And the real estate in this case is not residential, it's commercial. So these are apartment buildings, office buildings, warehouses, etc. It's really what we call middle of the fairway. It's income producing properties with very mild transition. And once again, that's designed to protect the principal and generate high current income. So maybe what we can do is spend a few minutes talking about Ares Real Estate Debt Platform, talk about a couple of the deals, and then open it to questions. So if you look on page 13, this is how we're built. We've decided to invest pretty heavily in a regional office system, and we have offices in New York, Chicago, Los Angeles, and Atlanta, and over time we'll expand that geographic footprint. The reason for that is, we think real estate is very much a local business. You need boots on the ground. You need originators that live and work in the markets where they lend. And I think that's led to a great track record for us. We've originated in excess of $5 billion worth of these loans. These are directly originated. And what that means is we do everything in-house. We source the deal, we underwrite the deal, we asset manage the deal for the life of the loan. We're not buying other people's loans, we're not buying syndications, we're not buying mezz. These are directly originated first mortgages. We've had an exceptionally good track record, and although I'm semi-new to Ares, I've been doing this for a very long time, and I've launched a whole variety of real estate investment vehicles during my career. This strategy is focused on big markets. So these are markets with generally more than 2 million people. And that's roughly the top 30 MSAs in the country.
Mr. Chairman?
Yes, I'm sorry.
Just while I hate to interrupt you, but while we're on that chart, I'm just wondering, in the southwest region, you have New Mexico. You're talking about 2 million population. I'm sensing that even though it's colored brown or beige or whatever, it might be black because you probably don't have any investments in New Mexico. Is that right?
So this particular strategy is top 30 MSAs. The cutoff is, I think, 2 million-ish people. I think Albuquerque is your biggest market. That's about 600,000 people. And I think that's the 61st largest MSA. So it's a little smaller than than the markets we're pursuing.
So what I'm saying is it might as well be black.
It could be. It could be. It's just
there is no intention. I mean, under your current strategy, to invest in New Mexico for the foreseeable future.
Not in this fund.
Right. I just want to verify one more.
Yeah,
Thanks.
not in this fund. You're welcome. But the goal is to get broadly diversified portfolio across multiple geographies that have large and growing populations. One of the huge advantages I think that we possess in the Ares real estate debt business is we sit between two really strong platforms. Ares real estate credit business is one of the very largest direct lenders in the country and if not the world. Close to $100 billion worth of assets under management. they are also a direct originator. So they have tremendous relationships with about 1,500 corporations. Those corporations are consumers of real estate. Many times they're the lease that underpins the real estate. And the credit group has over 50 sector analysts. So these are individuals that cover pretty much every sector that we might experience at the real estate level. So pharmaceuticals, aerospace, technology, grocery, you name it, they cover it. And our originators and their sector analysts work side by side. So every single day of the week, our originators are in a direct dialogue with our credit analysts to really look under the hood and get a deep dive and a deep credit perspective on the real estate. Because at the end of the day, that's what's paying the rent. And getting good credit insights is a material advantage for us. And it's also a great source of deal flow. On the other side of the platform is we have a long-standing, long-tenured real estate private equity business. So they are an owner-operator of the exact type of real estate that we lend against. Almost every deal that we lend against, we've either owned or currently own a property in the competitive set. So we can check rents, we can check operating costs, we can check taxes, and the synergies of being in between the two of those is really powerful. And it also means if we had to own the real estate, we could. We're rated special servicer, and that means that we have in-house capability to pursue remedies and get to the real estate if need be. We haven't had to do that. As mentioned, we've had pretty much a flawless track record thus far. The later you get into the cycle, the more important it becomes to have that in-house capability if you needed to own something. That's not our strategy, but I think it's a really important backstop.
Jamie, you're not suggesting, however, that you're putting paper on your private equity?
No, we don't lend to ourselves. Some of our competitors do that.
Right.
We think they're nuts. We don't lend to ourselves. Like this.
Clarify that.
Yes, okay, that's a great question.
On that same, we were just talking about that, Peter kind of read my mind. So as a firm, what's the facts that would determine whether you identify a piece of real estate that you would own versus lend to? What would make it go one way or the other?
Well, oftentimes we will be bidding to buy the property, lose the bid because that's very much an auction market, and we can flip all of that underwriting immediately into a debt quote. So we've already fully underwritten the real estate. We know who won the bid. We can translate that immediately into a debt quote. One thing that we really focus heavily on is the basis in real estate, and we know exactly what we would pay for an asset, and you can deduct 30% from that and get to the levels at which we lend.
Thank you.
That's a good question. We're really picky. We see a huge amount of deal flow. We close materially less than 5% of what we see. That's totally within our control. I approve every single deal that comes through the system long before it gets to investment committee, and we keep the aperture really small because that governs your future credit outcomes. As Julie mentioned, on page 17, we have a very, very senior, long-tenured, cycle-tested team. The average experience is about 28 years, and it's cross-disciplinary. So at investment committee, we have about half the individuals on committee are equity professionals, and half are debt professionals, and many of us have been equity and debt during our career. We also have one of the founders of Ares sits on committee and brings the credit lens to it. It's kind of looks at the relative value across our investments. If you just want to jump directly to a deal, I think I can share with you the flavor of what will be going into this strategy. On page 28 and 29 and 30, these are 3 seed investments that we've made. We just had our first close a little over 30 days ago. We had inventoried a few loans to anticipate that first close. These are almost my favorite type of deal for this type of strategy. These are low volatility, really high quality first mortgages secured by really great apartment buildings. So the first 2 deals are in and around Raleigh, North Carolina. Raleigh is a great MSA, lots and lots of new jobs. It's a great, broadly diversified economy, tremendous universities, and a lot of in-migration, a lot of job growth. That's what we look for. These are brand new acquisitions. They're new-ish properties. One was built in 2013, one was built in 2009. So they're very functional properties, 10-foot ceilings, highly amenitized. These deals would stand on their own today in an agency execution. And what these really are a bridge to agency. So Freddie, Fannie, and HUD are providers of debt for multifamily owners. Our loan is designed to facilitate the acquisition of the property. New owners going to just touch up the property about $5,000 a door, which is what we consider a super light, property enhancement. Increase the cash flow, and we think in about 24 months go to Freddie or Fannie and get a 10-year mortgage. So that's a very typical execution for us. We like it. There's a lot of fresh cash equity in the deal from a borrower that we know and trust and have lent to in the past. We are also an owner-operator and lender to hundreds of thousands of multifamily units through the years, so we know this property type really well. If you jump to page 30, that's the third deal. This is a brand new Class A property in Plano, Texas. I don't know if anybody here is familiar with Plano. Super high growth market. This is 2 miles from State Farm's new campus. So I think 20,000 jobs just from State Farm. Brand new property. We're getting, I think, paid exceptionally well here. We're getting LIBOR plus 290 plus some fees. So you're right over 5% right out of the gate. We anticipate having hopefully 30 to 40% of the portfolio in this type of deal. So once again, really simple strategy. We think it's the simplest strategy in the marketplace. First mortgages only, high quality real estate only, and high current income. And with that, I'll open it to any questions.
On your page 24, you talk about the leverage at the portfolio level and how you might be dealing with that leverage, whether you would keep it in warehouse loans, securitization, or what you do. Tell me what you're foreseeing most of your loans being held at.
Sure. So that's a great question. The other large strategy that we run is a publicly traded mortgage REIT called ACRE, A-C-R-E. It's listed on the New York Stock Exchange. That is a much higher returning strategy, and it uses significantly more leverage than what we'll use within this fund. This fund is 2-to-1 leverage, and the way to look at that is it's 50% leverage against the property value. So if you looked at the external leverage that we'll utilize, it's no more than 50% of the property level. In industry terms, that's considered very low. ACRE, on the other hand, runs at between 3 and 4-to-1. We have the right to run it at 4-to-1. Historically, we've run it at 3-to-1. We are not a big consumer of leverage. We could easily lever ourselves deeply into the promote, and we've chosen not to do that. Because we've been running a higher leverage strategy in a public setting for many, many years, we're extremely well banked by the providers of warehouse lines. With regards to this fund, we anticipate creating a series of small warehouses. And the reason we want a series of small warehouses is we don't want to put all our eggs in one basket. So we could easily go to Wells Fargo or Bank of America and get a $500 million warehouse line because we have those relationships in force today. We will much prefer to do a series of $150 to $200 million discrete warehouses that don't touch each other, because the risk in a warehouse pooled financing is you get, I call it a trash can fire in the garage, like burns the house down, and we're really, really sensitive to that. So kind of part one of the leverage is a series of small warehouses. Part two is we typically take the loans out of the warehouse as soon as we have sufficient number of them. We go to another Ares large client, typically a large insurance company, get that pool of loans rated. They will take all of the investment grade, and we'll hold the rest. And that's a really structurally durable, match term, match financed form of leverage. That's our preferred execution. And we've done this many, many, many times, and we're exceptionally well banked.
Question?
Mr. Chair, and these are probably much more basic questions than what Linda has. So just three quick questions. So, and I don't know if this would be for Paul or for Jamie, but so one of you mentioned that this was a new strategy for SIC. So what particular aspect of this is new versus what we've done before?
Well, we've done this similar before. The Brookfield strategy that we had approved October or November last year was a similar debt strategy like this. This is our relationship with Ares is also not new because we've done investments with them in Europe. This is the first time we've done a fund with them in the U.S., a debt fund or a equity fund for that matter.
Okay. All right, and then my next question is, how many properties are in this particular fund?
So we literally just launched in the kind of the cycle to originate a loan in this business about 60 days. So we're only we're like 45 days since we first closed. We have 3 deals. The 3 deals I mentioned are earmarked for the fund. We anticipate when we're fully built, what you're really hiring us for is diversification and durability. So we'd be hopeful to get, between 75 and 125 loans in a fully constructed portfolio.
Okay. All right, thank you. And then my last question is, what other types of investors will be participating in this fund?
Sure. We have attracted quite a number and range of different types of investors. I would categorize them as U.S. and non-U.S. sovereign wealth funds. We've had insurance companies come in. We have had interval funds invest with us. We have another non-U.S. public pension fund who will be investing. So it's attracted a wide array. And in different types of debt strategies, it has run the gamut from endowments, foundations, corporate pension funds, and so on.
You said interval fund? That's a new term to me.
Thank you.
You could think of it as a type of more of a mutual fund type structure that invests in other types of funds. So almost more similar to a fund of funds.
Sure. It's typically structured for retail investors, so small investors that are committing to that fund, that then that fund goes and invests that capital.
Got it. Okay.
Thank you, Mr. Chair.
Are there other questions? I have a very unsophisticated question. So why would a borrower come to you for a 3-year loan as opposed to putting permanent financing on at the outset at presumably even a lower rate than you're getting?
That's a great question. The market, first of all, just taking a step back, the U.S. commercial real estate debt market is a big market. It's about a $4 trillion investable market, which I love. It's a very granular, fragmented market. That market loosely bifurcates into floating and fixed. If you owned a property and the cash flows were absolutely perfect, and you didn't think that you could improve those cash flows by even $1, and you just wanted to what we call set it and forget it, you'd go to a life insurance company or a CMBS lender, and you term it out. You'd get 10-year fixed rate money, and you just put it under your mattress and forget about it. However, if you and every one of us has either lived in or driven by that apartment complex that's in a great location, but it's tired, needs a little sprucing up. If you thought that you could, by application of your knowledge, increase those cash flows by 20%, you wouldn't take fixed rate money because you'd be leaving a huge amount of proceeds on the table. The tricky part about fixed rate money is there's tons of call protection. So if you increase the cash flow by 25%, you had this 10-year note on it, and you couldn't take any more proceeds, you can't refi because you pay a huge penalty. You start life in the floating rate world, our average loan stays out for about 28 months, and then the second you'd optimize the cash flow, you pay us off, and then you go and term it out? That's a really good question.
Thank you.
And most buyers think they can add special sauce to, you know, to whatever they're buying. So.
Most buyers. Tim, did you have a question?
No, I just, this is just, to me, this is one of them that probably gets us a little bit of, it's one of the ones we might get criticized for because it doesn't do one thing for the state of New Mexico, other than return money. I mean, because all these other states that are out here, that are those $2 million areas, they bring all their trash and their wind turbines and put them out on the plains to look at. So we look at them and they don't have to. And then, all the investments and the jobs go there. So sometime or another, it just seems like there ought to be some ways that you can figure out some way to move New Mexico forward somewhere in this. I mean, it's the way I look at it. I mean, it's yes, it's good for money, and it's probably somewhat better to most of the people in the United States, or at least in New Mexico, if we invest in the United States rather than Europe. But this is just for money. But like Senator Rawson said, it's really hard to sit down for me to look at a vote that we're excluded from. To look, putting our money into a place that excludes us from participating. And that's, that's just, other than money, then there's no asset, there's no reason for us to vote for this other than except for money for the fund.
Right. Remember, Jennings, you're going to find that virtually across our entire real estate portfolio. We, the biggest market that we have here is a top 60 market, and most of the institutional managers are not going to go to Albuquerque. It's just the way the real estate market works, the way our general partners work, and we can go up and down our core portfolio, our value-add portfolio, our opportunistic portfolio, and very rarely, except for maybe in a very unique circumstance like elder care or mini storage or something like that, very rare that they invest in the state of New Mexico across the whole portfolio.
Linda, please.
I understand where you're coming from, and it would be lovely if our objectives all crossed. However, we are fiduciaries of this fund, and our objective is to make money for our beneficiaries. So as a fiduciary, that's how we look at every investment. And that's got to be our primary thing. And we also have seen where diversification is very important. We should be diversifying not just in New Mexico, but elsewhere, not just in the U.S., but in Europe. We saw how in our public equities, the European market is way cheaper than the American market right now, and it's prudent to invest there. So we should be looking as fiduciaries for the benefit of our beneficiaries, and that is a monetary benefit that they are looking from us for every year where we distribute money to the state for our beneficiaries. So I think this does meet our criteria, it meets our policy, and I think this is exactly the type of thing that we do need.
Scott?
And I would add to that, and I understand what Member Jennings is saying about direct investment, but I think the number that was quoted earlier, that I think in budget year 20, our distribution is going to be a little over $1 billion to the state as a result of this, partially as a result of investments like this. I think it's incumbent upon the state to take that $1 billion and invest it in a way such as we grow the state, grow the population, so that we then qualify for stuff like this. So I think that's, we also have to look at that aspect as well.
Are there any other questions? Yes, Tim?
But just in looking at it on a facade, looking at it, how can we get anywhere if we don't have the infrastructure for the jobs? We have to have jobs here to even get somebody who can afford to live in one of these classy apartments. If we don't have jobs in this state, so maybe sometime or another, even though I understand ours is fiduciary, but sometimes maybe we need to have some funds to do infrastructure or something that could get people to come here to provide jobs. Because we educate all the smartest and brightest kids, a lot of smart kids in our schools, and where do they go? And it's easy. I got a daughter living in Houston. I understand that, but it's just things to look at. Somehow or another, we need to look at some kind of focus in here as well that I think works for infrastructure to improve the opportunities. Yes, Our job is to produce shares. But if we can't find someplace to help find job shares, we're never going to get ahead.
Actually, Mr. Chairman, I'd like to weigh in as well. So just kind of piggybacking off of those comments, and if you've ever been an elected person in New Mexico, I think you sort of feel this a little bit more deeply because you are, representing your community. You kind of see these struggles and the challenges they have personally. So I would say I plan to vote for this investment. Certainly, I think it seems prudent from what I understand of it. But I think a more general question is, what is the SIC's role in creating an economy in New Mexico that rivals Raleigh's? And maybe it's not investment in the real estate market, but I just to our staff, that's kind of a broader question that I would love for this council to tackle.
Okay, that's a good point. Linda, are you ready for a motion?
Based on the recommendations of the Council Investment Committee, Real Estate and Real Return Advisor Townsend, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve up to a $75 million commitment to Ari's Real Estate Enhanced Income Fund, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, any other comment or commentary? All in favor, please say aye.
Aye.
Anybody opposed? Okay, please show Lee Rawson opposed. Did we get a vote from Mexico?
Yes, aye. Thank you.
Thank you. All right.
Thank you very much.
Yes, thank you so
very much.
After all the review that has gone on with this investment, it's most helpful if you vote no to give us an idea why you voted no, because it helps us on selecting other investments.
Linda would jump in with everyone. Without complimenting more, but we're very concerned about the mechanics of the structure. Leave it at that.
And for me, I might follow, I don't know what that means, so if we can make sure that the mechanics of the structure, so that new members get a background about some of the discussions, where there may be disagreement, that would be helpful. And we can do it at the next meeting with that. I want to make sure that we respect that dissent and we also answer your questions so that I understand it. That would be great. Thank you.
Okay.
I'm going to just keep leaving it to you. You're doing a marvelous job. I left my glasses.
Oh.
Trust me.
Okay. Next item is Starlet, please.
Okay.
Starlet.
Well, we have one manager that is not an optimal fit for the portfolio. It's William Blair. And we would like to issue an RFP to look for a manager that is a better fit. So William Blair has a 2 times allocation to India relative to the benchmark, and India is a market that SIC is not registered to trade due to difficult registration requirements. So what this means is that the SIC accounts, India holdings, are significantly different than William Blair's composite or model portfolio holdings. And we would look for a manager that had a similar allocation to India as the benchmark, and this would allow the SIC's account to be similar to the strategy. So plan would be to issue an RFP to look for an emerging market manager, to do an international equity structure study, and then to return to the CIC and SIC in May with a recommended portfolio.
Okay, and is traditional, we usually have a council member join you in that evaluation?
Yes, correct. And Linda has graciously volunteered.
Okay, thank you, Linda.
Thank you.
Is this a voting item?
Yes.
Yes,
Okay.
it is.
This is the second
Yes.
one right here.
Thank you.
You're welcome. Even though I have my glasses.
Linda, do you want to give us a motion then, please?
Based on the recommendations of the Council Investment Committee, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve issuance of a request for proposal seeking international equity emerging market managers as memorialized, reviewed, and discussed today by the council.
Second.
Okay, are there any comments or questions? All those in favor? Aye.
Aye.
Any opposed?
Aye.
Okay, that passes unanimously. Thank you. The last item under investments are the renewals of our contracts.
Okay.
With, 5 or 6 investment.
Yeah, so we would like contract renewals for 7 international equity managers. The international portfolio has performed as expected, and each of these 7 managers have fulfilled their relative or respective roles.
Let me also point out, just so that people know, we have extensive amount of written material in the book to support this recommendation, so I don't know that there's any need to reiterate that here, but if there are questions, I think we should go to those questions.
Yeah, and the contracts can be terminated with 30 days notice.
They're never locked in. Nice thing about
At any
this.
point.
I should know the answer to this based on the binder that was provided to me, so I apologize. What's the term of the contracts?
This would be till June 30th, 2023. It's a 4-year contract.
And that's typical in the industry that you do a
It's
4-year
typical.
with the 30-day unilateral.
Right, and at any point the council so desires, they could terminate any manager with a 30-day notice.
Okay.
So this is presented as one item, but as has been asked by several of our members, these should be voted on separately. Is that still the preference of the council to vote each of these separately?
We got one no, we got one yes.
Lee, you're...
I would prefer separate. They're individual contracts.
Okay.
I just think in terms of transparency, it's a better deal. So it takes us 5 minutes longer, but...
Can I raise one?
Yes.
Portfolio construction. You're building a portfolio based on managers for diversification purposes. If you veto one of the managers, there could potentially be return implications or portfolio performance implications from not having that one of the 6 managers there. So you could vote, as you're right, however you would like, but there are performance implications when you start changing the selection of managers, because what Starla has in this group is managers do different things. They don't buy the same securities. So you heard about Donald Smith, who was an international type manager. If you cut this out, then the risk profile will change on the portfolio, and so you just might want to make sure you understand what that implication is were you to vote no as a diligence matter, because you are in fact voting on the portfolio asset allocation construction.
Yes, I would argue that I don't think the discussion has anything to do with the portfolio application, and my expectation is that all of these will be renewed, and so that's kind of like a bogus argument. I mean, the point is, if we're going to extend a contract, should we vote on each contract individually? And if for some reason there was a change, then I think that we need to talk about portfolio distribution, but I don't expect any of those would not be confirmed.
Very good. All right, well, let's proceed on that basis. I think we're mindful of the fact that if they don't all pass as a group, we've got an issue of portfolio construction that we'll have to deal with. But I guess, Linda, you get the...
I get the job. Based upon the recommendation of the Council Investment Committee, RBK, and SIC staff, I move that the State Investment Council approve BlackRock Institutional Trust Company. Let's see, I'm going to have to change this. Under terms and conditions reviewed and discussed by the council today, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Commentary?
Mr. Chairman, just a question, please. On page 130 of our startup, BlackRock is negative in 3 of the last 5 years. Can you kind of go into that a little bit? Talk about the difference in the volatility and why we see those numbers like that?
Negative. I'll take that. Just that is more of an indication of the asset class they're operating in. That's the emerging markets asset class. If you see the second line in the
the third box from the top, and the main box, the index itself was negative in those same years, and in those 2 of those 3 years, BlackRock protected very well. And so if you invested anything in emerging markets that year, you likely would have had a negative return. So that's why they're showing negative return as well.
All right. All those in favor? Aye.
Aye.
Any opposed?
Aye.
That was an aye. All right, that passes unanimously. Linda?
Based upon the recommendation of the Council Investment Committee, RBK, and SIC staff, I move that the State Investment Council approve Templeton Investment Council, LLC, under terms and conditions reviewed and discussed by the Council today, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay. Yes.
Yeah, Mr. Chairman, I just say that I would suggest that we could take, it's the same motion, just substitute the name.
Thank you.
I think we don't need.
Oh, good.
The point is not to drag it out. The point is to have a separate motion, a separate.
Right. A record of a vote on each one. This is what we're trying to do. All those in favor, Debbie?
Aye.
And any opposed? So that passes. The next one is LSV.
Okay. I have the same motion
Second.
with regards to LSV asset management.
Second.
Again, all in favor?
Aye.
Any opposed? None? All right, that passes. We move to MFS.
Again, it will be the same motion, but with regard to MFS investment management.
Second.
Very good. All in favor?
Aye.
Nobody opposed? Passes unanimously. Thank you.
And again, the same motion with regards to T. Rowe Price Associates, Inc.
Second.
All in favor?
Aye.
Any opposition? Passes unanimously.
And lastly, the same motion with regards to Newburger Berman LLC.
Second.
Again, all in favor, please? Aye.
Aye.
Any opposed? That also passes unanimously. Thank you very much for expediting that for us. And I think we now turn to Brent's report. Item 4, right.
Should we know what to do?
Brent.
Yep. Go ahead, Brent.
All right. Especially for the new people, I wanted to touch upon just a few things, if I may. On page, I guess it is page 139, starting there. I do, on a periodic basis, for all the meetings, I should say, include the budget projections for the most recent month. And I'm not going to go over these in a lot of detail, but if you get back to your offices and have any questions, any input, I'm happy to answer. Or if you have questions now, I can answer those as well. And then on page 144, the investment holdings report, I just wanted to highlight a couple things on the investment holdings report, if I may. On page 145 is an index. On page 146, you can see for the month of December, and this is the report that we just completed last week. This is total assets managed as of the end of December, $23.2 billion. If you go forward one page, you can see the land grant permanent fund. You go forward another page, you see the severance tax permanent fund. These are the assets. And then finally, you see both the tobacco, the water, and on page 151, I think Steve mentioned earlier that we have clients that have investments with us of over $1 billion. You can see those as well. I wanted to emphasize on the investment holdings report, generally those first 4 pages or 5 pages where you have the land grant, the severance tax, the tobacco, the water fund, and the clients.
those are kind of a snapshot as of whatever period that you're looking at. Any of the subsequent pages on the schedule usually deals with showing activity, rolling it forward on a monthly basis or a quarterly basis. And then finally, because it's such an important part of the investment holdings report, if you go to page 177, having some technical problems here.
And for those of you that have the print version, I think, is that page 32, Brent? Are you on the summary?
Yes, I am, Steve. And thanks for asking that.
Yeah, because otherwise I can't find it. Okay, 32.
You see on page 32 or 177 if you're on Diligent. This is kind of the notes for the report. And I wanted to just point out a couple of things that I think are important, especially as it relates to the new land commissioner. You can see under that first bullet, it says the monthly contribution from the state land office is $74.6 million. This is actually the proceeds that we get from the state land office. And it does note that it's decreased a little bit from November. And I guess the important thing there is if you compare it to the contribution from a year ago, you can see the increase. The contribution last year in December was about $41 million. And then also we try to highlight here on a monthly basis what the distributions are from both the land grant permanent fund and the severance tax permanent fund. So that's really all I wanted to point out on the investment holding report. If you spend a little bit of time looking at the report and kind of time numbers back and forth, you'll get pretty comfortable with it very quickly. The key pages, again, the first 5 or 6 pages, which is kind of a snapshot for the various funds, and then the note page at the end. And then also I wanted to point out, because I think it's so important, on page 282, or let's say 262 in the Diligent material. It's a one-page handout. It shows the basically the beneficiary interest in the land grant permanent fund. And you can go through and see on this page, like common schools, you can see that they have 85% of the land grant permanent fund. If you look at New Mexico Highlands University, you can see that they have an interest. You see the school for the deaf, the school for the blind, Eastern New Mexico, Northern New Mexico. You can see all the participants or the beneficiaries, what their interests are in the land grant permanent fund. I provide this just because we periodically get questions, especially from the beneficiaries, because they look at this on a regular basis. Any questions on this?
Yeah. Brett, if you would, and maybe Charlie, would you explain to the members how we send the monthly reports to the beneficiaries? And Charlie, why don't you comment on the fact that you just sent out a letter to the beneficiaries at the beginning of the year?
Sure. Specific to the letter, many of the beneficiaries are also clients for us. And so as part of our client services, we have been reaching out to them and reminding them when there's heavy market activity, they ought to check their balances as they compare to their long-term targets. Make sure you rebalance just as a matter of course, because when the equity markets run, you're going to get out of balance. When they drop back, you're going to get out of balance. It's just a matter of course, because I think many of our clients, we have 21 clients now, many of them do tend to let it sit and they forget it. And so we're going to be a little more active in reminding them not to do that.
So let me just be sure. I don't want to be too elementary or too detailed, but I'm not sure everybody understands what our business is. So the council oversees 4 major state sovereign wealth funds. The tax fund, the land grant fund, the water fund, and tobacco fund. In addition, though, in effect, as a public service, because we have a competent investment function, we provide the ability for any governmental institution within the state to come to us and say, please invest my money for me. And we do that as a service. clients. That's what we call our clients. We have about $1 billion or so in client money. A couple of important points about that. The first is we do not decide how those clients will invest, what the allocation will be. They are responsible for making their own decision when they put the money with us and they sign a joint powers agreement with us that identifies that. And then we provide them with reports and a return. And they have almost immediate liquidity, I think, Vince. I don't think there are any tie-ups. They can take the money out whenever they want. They can add money whenever they want. But it's a terrific opportunity for the state because we don't charge anything other than actual direct out-of-pocket costs. We don't allocate any of our management costs or any of our budget other than direct fees to these entities. So anybody in the state, universities, political jurisdictions, etc., can take whatever excess of the funds they have and let the State Investment Council provide that service for them. So we always are talking about our clients and we're talking about our basic funds. The clients are a small portion, but very important to us, and we spend time making sure they understand what they have and what their allocation is.
Peter, we also ought to mention that we encourage our clients to have their own consultants, have their own investment advisor.
Right. But again, yeah, and just to point out, Vince, you're much better at numbers than I am. But if an entity such as one of the universities decided to go out and hire an investment advisor, they would be paying 50 to 100 basis points possibly to have an advisor manage that money. That's a huge amount of the return that goes to an advisor. Not that there's anything wrong with huge returns to advisors, but by using our services to invest money, they're down in a few basis points, at 5 or 10 basis points. So it's a tremendous savings and a great benefit to the state to have this function, at least in my personal opinion, and I think the rest of the council would agree with that.
Peter, I've never actually thought about this part of it. Can one of these clients choose to use our allocation? In other words, can they come in and say, we want it to be done exactly the way you're doing it?
You might remember that a few years back, 3 years or so, we broadened the panoply of funds, pools that they can participate in. And now I assume it's 100% of our...
Not the real return yet.
Oh, not the real return. Anything but real return. And yes, they could say, we want to track your allocation if they want.
But they have to make the decision.
Correct. And that's important from a liability standpoint.
There are some size limitations on the private markets. If you only have $100,000, you probably shouldn't be tying in an illiquid asset class. So I think it's about a $10 million threshold before you get into private equity and those kinds of pools.
It doesn't get talked about a whole lot, but there are several institutions that could have really benefited from having their money here for the last 5 years. But we can talk about that.
Richard sort of asked, what do we do for the state outside of the investment? This is an example of it where you saw Vince's chart on his graph of the various asset classes, real estate, real return, public equity, private equity. If you're a small county or a state or even the city of Albuquerque, you're not going to have access to the areas of the world most likely, or you're not going to have access to, pick your international equity manager or real estate manager, whatever the case may be. So we charge none of our overhead to staff time. All we do is allocate the direct cost out to these people, and then they say, what are you looking for? You can participate alongside us because we're already making the investment, but you have to decide how much you want of it. And so you asked about sort of, what more can we do for the state? What's the service we get? That's sort of a component that's not really talked about.
And then finally, if I may just take just a couple minutes, and I'll be very, very brief. Within your materials, and I'm not so sure everybody has a manual copy of this, but if you'd like a manual copy of the audit report that was just completed, I brought enough for anybody that wants one. But I wanted to just point out a couple things on the report. If you go to page 3 of the report, or page 182 of Diligent, the first paragraph there is the opinion. This report is the report of Moss Adams. They are a new firm this last fiscal year. We had a rotation requirement from our prior firm, after 6 years. So Moss Adams was our auditor this year. And usually, and I have to say this, the first year after you switch auditors is a little bit challenging, but I have to say this year went especially well with Moss Adams. On page 17, and it's page 197 for diligent, you see within this is called the statement of position, the government funds. You see the general admin fund, the land grant, the severance tax, and the tobacco on this schedule. This is kind of a balance sheet. They call it a statement of position in government parlance, but it's basically a balance sheet for those 4 funds. I should point out the general admin fund is the fund that the budget is actually run out of. It's funded and we pay expenses out of that fund. And then if you turn over to page 19 or page 199 of diligent, this is the actual revenues and expenses as it relates to those major funds, those governmental funds. And you can see under the land grant permanent fund, you see $689 million of distributions. Those are distributions that go out to our beneficiaries. At the same time, if you go up to the upper part of that schedule, you see inflows, and these inflows came from the State Land Office of $690 million. And then next, if you thumb over to page 22 and 23, which is 202 and 203 of diligent, these are the fiduciary funds. These are the items that don't fit under governmental funds. That's the water trust fund and our external clients. If you're wondering how these relate to the investment holdings report that I just talked to, we talked about 4 major funds: the land grant, the severance tax, the water, tobacco, and the external clients. They're on one of those 2 schedules, but the fiduciary funds only include the water trust fund and the external clients. If you turn over to page 23, that's the income statement. And then finally, on page 79, I like to point this out because I think it's really important. And I think it's 261 as it relates to diligent. There was no findings. Okay, this is something me and my staff are very proud of. It helps to have a good staff. It helps to have people that are really focused on detail. We have some very good people that we work with from DFA. DFA and the state auditor provide input before this report is actually released. So if you know people over at DFA and they deal with us, ask them how we do. And I think you'll find that we do pretty well. We have the bar set very high. We try to do well. We'll continue to do well. This is my 7th audit report that I've been involved with. I enjoy what I do. I enjoy the people that I work with, and it's a real honor to do what I do. And that's all I had as far as prepared comments.
If I could just add that I don't want to embarrass my fellow Hornet friend over there, but he has done a phenomenal job in this role. And I want to make sure sometimes it doesn't get acknowledged, but every time we get the findings or no findings, every time we hear anything about the accounting part of this, what we do, Brent's done a great job, and I think we ought to recognize you for that job.
Thank you.
Thank you.
And I would add to that, having come up through this external auditor path earlier in my career, you mentioned that sometimes these transitions between auditors are difficult. The reason they're difficult is because when you're transitioning, if you have an organization that doesn't have their books together and has prior audit comments, it makes that transition more difficult. And the reason it's not that way here is because of you and your staff. So I would echo what Harold says. Kudos to you all.
Thank you.
Congratulations.
Okay. I think we're back on the agenda. And it says closing matters, Governor Ruhan. First item is a tax stabilization reserve legislation. And Charles, do you want to take us through that?
Mr. Chairman, Governor, so we're looking at page 264. There is a copy. It's an updated draft of a bill that would put the tax stabilization reserve under the council's direction regarding investment. The changes that we made are going to require additional reporting on a quarterly basis, in addition to some heavier, deeper dive annual reporting to the LFC, the Revenue Stabilization Tax Policy Committee, IPOC, and others as requested. As you know, the use of the Tax Stabilization Reserve requires approval of both the executive and the legislature. As you know, which all have seats on the SIC and multiple points of influence and information here, it would be, the SIC would be tasked to basically propose an appropriate level of risk. We think there are enough checks and balances on the board to help define that number. It's something the council currently does to a smaller degree with the water fund and the tobacco fund. Overall, the investments would fall under the umbrella of the Uniform Prudent Investor Act, as all of our investments do. These monies, as they are technically housed in the state treasury, would require some consultation on staff support with the state treasurer to make sure he is okay with the proposal we're making. It's not that different, frankly, from your role on many different state boards and commissions, Mr. Treasurer. So we believe we check the boxes here as far as getting enough voices to the table. These are technically short-term investment funds, so risk is going to be minimal. We want minimal, but at the same time, we believe that the state could get another 2% by putting a small portion, maybe a fifth of these investments in alternative assets like real estate that we believe would still provide enough liquidity, but at the same time could deliver additional returns to the fund, and we wouldn't be leaving basically $10 to $12 million on the table just by taking a longer-term view with these assets. We believe that we'd have enough time, 1, 2, 3 months, advance notice, should we have to liquidate these funds. And so that's the proposal we have in front of you. We're looking for an endorsement today to carry this forward. We have a good bill sponsor in Tomas Salazar. He's the chair of the Investment Pensions Oversight Committee. They have already signed off on the previous version. We'll have to work with them just to put that forward. But we think we've addressed your concerns, but I'd like to hear if you have anything you'd like to raise.
Are there any comments? I know we...
I have a quick question, Mr. Chairman.
Mr. Chairman, this is Lynn. I hope you can hear me. Just a point of information. I understand we have a 60-day session, and this piece of legislation is likely to go through more iterations, if I'm correct. Is that correct, Charlie?
It certainly could, Lynn.
Okay. I would recommend at this point that we not take a vote, because this is still a discussion draft. It will, in all likelihood, continue to change. And I think the time for a vote would be when the legislation is finalized. And I have a couple of suggestions. One, you addressed the consultation with the state treasurer. We had discussed having an identified client, if you will. I think this addresses that concern well. On the second point, there are some language changes I believe should be addressed with respect to the council's role. The council's role is not to choose investments, but to provide oversight and supervision. The constitutional language is supervision. I would suggest that be incorporated, but these are all finalization matters that could be addressed at a later time.
Lynn, what we're asking, this is Steve, Lynn, what we're asking for today is the council's endorsement of this concept, if you will, of investing the tax stabilization reserve. It would be very difficult to come back with changes in the legislation that come from amendments as it goes down the road, and the timing could be a problem for us. So I would ask the council whether they would like to endorse what's been presented today or do something different.
And before we respond to that, we actually interrupted Tim.
Well, that's quite all right, because Lynn's a long ways away.
But very present.
My question, I guess, is the first page, lines 23 and 24. Why are we taking out the opportunity for the legislature to fund this with other monies?
I'm glad you brought that up.
That's Mr. Treasurer, that's certainly a good observation. We can take that back to the drafter and see why that particular line on 23 and 24 was stricken. The idea is not to limit the legislature's power in any sense. So certainly we're glad to get you a better answer on that.
Who is the drafter, Charlie?
He's new, Anthony, I believe. I'll have to get you his name, sir.
And then why, and Lynn kind of alluded to it, but why with consultation with the treasurer? Why do you feel that's necessary?
The thinking there, because the monies are Treasury monies, that you'll recall when we had this discussion in November, the idea was making sure that the legislature had solid reporting, and the other lever that you need is the executive. And so we initially looked at putting the DFA secretary in this kind of consultation or authorization role. The drafter had a tough time getting comfortable with that, and I mean, he consulted senior people at the Legislative Council Service to get there. And so we felt it added another layer working with your office and you to make sure that everybody was comfortable with the risk tolerance and kind of investment horizon.
I can defer to Olivia, and then I'm happy to.
All right, Governor, Mr. Chairman, so just, Mr. Eichenberg, if you look at that language, I think what they did was just try to shorten the intent, if you could just go up to the previous page, because the word appropriated is added after consistent money directed or appropriated. So it's only the legislature that can appropriate. And so they just basically rearranged that language, so it shortened it, but it's still the same intent, it looks like to me. That's just looking at it. And then I was just going to ask, what percentage of the overall reserves is this approximately? It looks like it's a very small percentage.
So
the total reserves.
Yeah. So I would defer to Dawn. Dawn mentioned that this fund would probably have a balance of about $650 million at the end of fiscal year 19. Where that fits into your overall reserve picture, I don't know that I'm the right person to speak to that.
If the budget's $7 billion.
Dawn, do you have a comment?
Yes, I do, Madam Chair, council members. So the total general fund reserve ending balance at the end of FY18 was $1.1 billion, and this fund was about $530 million at the end of FY18, so a little less than half.
Roughly half.
I would just add, so I am in support of this this proposal. One thing that I think we should just keep in mind as we go forward is sometimes reserves are used as a cash stabilizer in the general fund. So since our revenues are cyclical, we look to our reserves to kind of get us through the lean times. But it seems like, and I assume that has been vetted, that we just would want to be cautious of that as we go forward. Less than half, I'm assuming, is looked at as being reasonable in terms of having enough money in the coffers to pay our expenses at any point in the year. But that would be something we just want to keep in mind as we go forward.
And Madam Chair, just tapping it too takes 2/3 vote. Right. Legislature.
And I'm just talking on a cash basis.
Yeah,
so it's just the cash is like at the treasurer, and that has provided that cushion that we need in months that we don't have as much revenue to be able to write the checks. It's more of a cash basis than it is like an appropriation or use basis. We can talk about that.
So, Mr. Chairman, if I might add a further comment in light of Steve's comment and the timeliness of an endorsement, I would suggest that on page 2 of this draft, item 3, subject to approval of the State Investment Council, be amended to read subject to supervision of the State Investment Council to be in conformance with constitutional and statutory requirements.
What was the word you used? Supervision, okay, yes. I don't think anybody would have a problem with that kind of a change.
No, there's a big difference between supervision and approval.
Yeah.
I mean, because this is the whole issue that we're talking about. Back to line one on that, as to whether or not the state investment officer is going to make the decisions, or the state investment council. Right. And the state investment council now can delegate that to staff. But this is changing it to where state investment officer makes the decision and we approve it versus us delegating. It's a whole different direction, and that's an argument that we're having already within the council. So just changing the word from approval to supervise, it's a whole different concept.
Well, except that our supervision
arguably, this is the current statutory and constitutional framework. You're absolutely right that we have done a deep dive, a lot of due diligence. We have legal opinions. We will have a much more fulsome discussion with the entire council, particularly to benefit our new members in all the details. But this is not the time in a piece of legislation for a new fund to address what has...
Yeah, but actually, in fact, I don't want to be a wordsmith here because he's probably better than I am, but I think we undertake our supervision through an approval process. That's the way we do it now. If we decide to change that later on, we'll be okay. But supervision is a broader term, and we define that currently, that we vote on these kinds of decisions. So I think that word works either way. And if we do change our policy going forward, it will work in the future. If we don't change, we still decide. We will supervise by requiring a vote of this council.
I think it's important that the council, the new members especially, realize that there's an open issue here that hasn't been determined, that there's not agreement on this part of it, and that is that in 2010, when this council began the process of making changes to what had happened 08, 02 to 10, the process became investment committee, here's what sees the investment, the full council sees the investment, the full council approves it. There's a move afoot to change that process to a certain degree. Some of us don't agree with that potential change. So, for example, I would argue that, I believe that this should say is the State Investment Council shall invest the money in the reserve. And that would be consistent with the way we're doing it now, which I believe is absolutely allowed under the statutes. There's been some argument about that. There's been debate about that. But I happen to be of the opinion that this is completely allowed. So I would rather see that be the State Investment Council rather than the State Investment Officer. And that then removes the need for any of the idea about supervision or anything like that. We have a disagreement on this.
Yes, and respectfully, Harold, because we have not had the opportunity to fully discuss and reach consensus and bring our new members up to full speed, the use of the word supervision, which is consistent with the Constitution and our statutory framework, does not change the status quo, but also does not use a back door to change the determination going forward. Our funds, our investment fund decisions are made by the State Investment Officer, and policy and oversight or supervision is provided by the council. And that's all we need to keep this discussion open so that we can appropriately vet it and at some point in the future reach consensus.
Yeah, but in looking at, if you look at item C there on, the State Investment Officer shall report quarterly to the Finance Committee. Where else does that say that he has to report how his investments go to the council? I'm just saying, if he's going to invest them, where's the letter in there that tells you it has to come back and have the council even know the investments? There's not any in that. And that's just, if you go through the council, then this body, who's appointed by all kinds of people from different areas of the state, gives some protection to everybody in the state that nothing goes wrong. You single it to one person, there could be a problem. He could take it and put it all in a bank. he can take it all, put it in the savings alone. And, you know, to me, I mean, it's better if we go through the council, because that's what each one of us has a charge for. We all have different people that we are responsible to by who appointed us, and we have an obligation to them. We also have an obligation to the people. So that's the way I see it.
Mr. Chairman, I would suggest as a point of order that this is not the time to have this broader discussion. There are very sensitive arguments.
But on that point, this is the governor. Olivia's got a question, Secretary Padilla Jackson, and then I have a couple of questions, and maybe I'm worried that it could be out of context, ladies and gentlemen, but a potential suggestion about how to move forward. Olivia.
Okay. So I have a suggestion.
Oh, fine. You're going to steal whatever I was going to say.
And so we may still have to go to Plan B, the governor's suggestion. This is not a huge change, but the way that I'm reading this language, it says the investment officer shall invest the money. So at this point, the investment officer does invest. The council doesn't invest. We approve. Would it strengthen or address the concerns if we actually moved number 3, where it says subject to approval of the State Investment Council up, so that this says the State Investment Officer shall invest subject to approval by the SIC, and then go on to talk about the Prudent Investor Act and in consultation with the Treasurer. So it just really highlights right up front that the State Investment Council does have to approve, but it is the State Investment Officer that actually invests, because that's his job.
Okay, so the issue,
that's a good solution,
a broader
but again,
issue that we are going to get into.
Is the word supervision for approval.
So,
what did you say, Len? Please repeat that.
I think that's a good suggestion to consolidate this up front, but the word supervision would be substituted for approval.
So for me, Len, and I don't have the full text because I didn't turn on my computer, so I apologize to everyone. I know it's here. It's not in the printed version of my book. But are there definitions at the front end? So part of making sure that when we use, particularly in the context of a conversation about whether we could approve or not approve specific language, we don't have definitions what any of this means. So that. And that subject, as Harold pointed out, to potential debate by the council. So given that, one, how does the council support legislation previous to this particular item? And the reason that I ask is it gets amended. And so there's no way to do a blanket approval until really the very end. Do you use a legislative committee with a set of guidelines, which is typically what boards do as you're moving through, that the intent has to be X, which is that we leverage the ability to invest without minimizing liquidity and the ability to pay our bills, so as long as we take those issues in mind, but using the structure of this body to be that investment mechanism. If that's the spirit of this particular legislation, it seems to me there ought to be a committee that is working on that, making sure that the spirit doesn't get changed, and works to minimize that we get the kind of amendments that would change the overall intent. But then before someone like the governor would have to either sign it or not, seems to me that the work of this council would be to determine whether or not the legislation as passed, if it passes, meets the intent of the idea in the first place, and also gets to some of the issues that have been raised today. I don't know how you fix that, because we can make suggestions, but they could get changed in any of the committees anyway.
Respectfully, Governor, this matter has been under review for over a year in great detail in the Governance Committee, which has the charter responsibility.
Okay.
And we have not yet had the opportunity to have full discussion. We do have a formal recommendation of the Governance Committee that we conform with the constitutional and statutory framework, which we are not presently doing. The alternative, as you suggest, would be to change the constitutional and statutory framework.
I
which
didn't
think
suggest
is
that.
under our mandate at the moment.
I'm pretty sure I did not, for the record,
Yeah,
suggest that.
Len, I think you're broadening the discussion. That was not something that we wanted to bring at this point to this committee. We're not currently prepared to have that debate. The only issue...
Who's we?
I'm sorry?
Who's we?
The council is not.
We-
My opinion.
Well, you're speaking for we, and
By
it's like
accepting
someone
the
made a decision
suggestion,
not to bring it.
Wait, Lynn, can you,
And so-
wait, Lee, you're co-chairing, which makes it really hard, but I can't hear Lynn when you're talking, and Lynn clearly can't hear us or see us when we're debating. Lynn, since the floor was yours, would you mind, Lee, if I have, and would you mind, Peter, if I have Lynn finish? And then we'll go to Lee, who's next in the queue. Does that work for you, Peter?
It's fine.
Okay, Lynn?
Thank you, Governor. I agree with the statement that was made that this is not a timely point in our agenda or agendas going forward to debate this important matter. We want to be sure we have fully informed every council member of all the due diligence that has been done, the legal analysis that has been done, have a very full and frank debate. My suggestion, since we're in a situation where we want to endorse legislation, is by using the word supervision, which is constitutionally in the lexicon, we can defer this important discussion to a later date and still endorse the direction of this particular piece of legislation.
Okay, Lee?
The issue I was trying to make is there are discussions by some prior to the meeting as to what will or won't happen. And this is an issue. This whole thing boils down to the friction in the council itself with control. Who's controlling it? How is it moving forward? Now, we did have, to answer your question before, we had a legislative working group which consisted of Senator Jennings, Harold Lavender, and myself. Given that, at least the two senators here had a little bit more relationships and understanding how the process works downstairs. What do we need to do to get things sold? How do we move that forward? Okay, since then, the powers that be basically dumped that working group and assigned it over to a governance committee, which doesn't have any of that representation on it. So there's some struggles in-house. I think the concept here is that the SIC as a body would support the investment of the
Tax stabilization fund.
Exactly. The mechanism and the wording of that is going to continue to be in dispute because we have this issue of control in this body. And that's one that needs to be, that's being addressed here. But it's a bigger issue, and this is just poking at it. But the fact is, as you heard Peter Frank say, well, we decided not to make that an issue here. Well, who was we? Because it wasn't the council, it was, a control factor. And that's what we need to just keep in track of what's going on in the turmoil within the agency. It's not so much individual investments, it's the control.
Very well, Linda.
We have the two permanent funds, the severance fund and the land grant. And the land grant operates under statutory and constitutional provision that is quite clear that the state investment officer makes the investments. The severance tax is a little bit more difficult to pin down, but it definitely says the state investment officer. We can delegate that to him. It's ambiguous whether it's the state investment officer to begin with, but it's somewhat ambiguous. The land grant is very clear that the state investment officer invests, and Harold is absolutely right. After 2010, the State Investment Council, being so swinging the other way from what problems we have had before, decided to have its oversight of every investment. That's not statutorily required. As a matter of fact, we are not meeting a statute of the land grant, which says the state investment officer does it. And we simply provide oversight. We don't do the investing. But now we are doing the investing because we got nervous. So in many ways, we are not operating within the spirit of the land grant statutory and constitutional provisions. Severance tax is iffy. So here, if we are now going to say that the State Investment Council makes the investment decisions, we are by statute changing what actually already is by statute. So we need to be very cautious, because this will be a very lively discussion when we come down to how we want to empower the State Investment Council versus the State Investment Officer. And it's probably not appropriate for this meeting, because we have too many people who haven't had an opportunity to get up to speed on what, even the investing, let alone some of the other nuances. And we need to give them an opportunity to see the way we operate and to review the statute themselves and to come to a really measured and informed decision. But I think my concern is that, and I believe that's what Lynn is bringing up, we don't want to change by statute what we certainly don't have now. We certainly do not have any statute that says the State Investment Council makes the investments. We have nothing that says that, but we are doing it now. So we want to leave it still open for how we're doing it now, but we don't want to change the statute until we have had this in-depth discussion over what we believe our function as a council versus the State Investment Officer's function is. And so I think that we just need to be careful about how we state it here, that we are not doing that. And so I think that's probably the most important thing. I have two other tiny issues compared to all that. One, I just wondered if, I know that this fund is to help us with our state bonding, to have a reserve fund. And do the agencies, the rating agencies, do they care if we have invested in other than overnights? Does that give us extra points or extra demerits if we have it invested with a duration longer than 32 hours?
Does anyone have the answer to that? I don't know the answer to that.
It's likely they would look at the portfolio and make some judgments. But I think what they'd see wouldn't trip any big. I can't trip any big triggers.
Okay. And then the other thing is, I just trying to clarify what it is we're being asked to do. I don't think, are we being asked to approve this draft, or are we being asked to approve of the concept that yes, we are willing to do the investing with the provisions that the draft has on?
We're being asked as a council to support this concept. The wording will be subject, it's the legislature that will pass this, not us. We don't have to say yes or no, it's up to the legislature. We are presenting this to the legislature as a recommendation, and we want to say that the council is in support of undertaking this function on behalf of the state. That's all.
But the spirit of the intent, I think we could do a better job as a council on the agenda, particularly because we are required and should, even if we were not so required, to provide as much meaningful information to the public as possible. It appears as if we are endorsing a specific legislative request in terms of those specific language items. And so that gets tricky because, again, we don't know how it'll end up, and there's some disagreement about statutory interpretation, and that gets even more complicated. But I could certainly be very comfortable in terms of the intent of investing the tax stabilization fund and using this entity to do so. And I think that we need to make it very clear that if if I'm correct, that that's really the intent of the proposal and the action item on the agenda, so everybody knows what they're voting for, that the recommendation, once the legislation is passed, is separate, because we don't know what will be in the legislation, and we don't know, we have not made a decision about how we want the definition and the terms based on whose authority is really occurring for these transactions and investments. So I'm clearer about that now.
That's a motion, Madam Governor. I would second it.
Okay?
So can I just ask for clarification?
Yes.
We are not endorsing?
So we're endorsing a concept that we believe that the tax stabilization fund should be a fund that could benefit from the State Investment Council's investment strategies and investment authority. What we're not endorsing is this particular bill in its current context, although the spirit meets our intent, because we have questions about the authority of the council and the investment officer, and how we deal with that now, I'm not quite sure. But that was my question about who, and thank you, Lee, for telling me that there was a legislative team here that was working on that, and then it became a governance council, or maybe I said that wrong, with different individuals participating. So we may still have to deal with that, because, and even if we could agree on the language today, then it gets really dicey for organizations and boards who say, I endorse this language, and there is a technical change, but you got a decision that you only endorse something else. It's really tricky to do that. Typically what boards do, or the boards that I've participated on in a productive fashion, is that you endorse a legislative concept. Often, if it's been a concept that you've been involved in for years, you're pretty clear about the language. But if you're not yet, you endorse the concept, and then you're pretty clear that there has to be a secondary meeting and a vote about what actually gets through the legislature, if it gets through. That's subject to another affirmation by the body that's responsible for doing that, so the council.
I think that's a very productive way to frame it, Governor. There's the opportunity for the council, after the legislative process is complete, to accept the mandate with the ability to concur and conclude that it is within our statutory framework.
So that's my motion, which is that we endorse the concept of having the tax stabilization fund as part of the portfolio here, and that the council and the investment office, based on the work that we do currently, that we would engage if that gets passed. So we have the authority to do so. But we will not endorse any legislation until that legislation in its final context is presented to the council. And Tim and the state treasurer has a second. I'm going to give it back to you now.
Thanks. No, I think that's fine.
So now we have to vote.
I think we're ready for a vote. Are there any other any further commentary or questions? All those in favor? Aye. Aye. Anybody opposed? Okay.
Is this on the agenda? Can we vote on something?
Yes, it was.
Yes.
No, it was an agenda item.
I thought it was.
So now I'm maybe belaboring this. Do we need to take any action on who would participate in clarifying language, responding to questions about who is the staff typically? I'm most comfortable, I hope I mean no disrespect by two individuals on the council of far more legislative expertise and experience than I. Actually, three now. We've got the most recent former legislator, the new land commissioner, so you've got a healthy four. God, never mind, I'm excluding everyone. We have a healthy number of individuals who have very productive, long-standing legislative expertise. But I'm more comfortable, and I'm happy to be overruled, that the staff are really supposed to be the experts in determining what the specific language is or isn't. But my expectation is that these experts on this council will be weighing in heavily, depending upon what the final piece of legislation looks like if it passes, and have clear opinions about the constitutional requirements and the current practices of the council. Is that fair? Or statutory?
Governor, if I might comment, I think you've made a good point about the expertise of some of our council members in legislative history. We certainly would value and want them to weigh in. However, the governance question of what is our constitutional and statutory framework is a matter under the purview of the governance committee. And unless we want to change charters and otherwise make adjustments, that's where this more fulsome discussion will occur, and we will be sure the full council is involved.
Okay, I think I understand that, but the staff will be responsible to legislative work and inquiries, and we'll use our governance structure during that process, our current governance structure, and then come back for a final vote at the end of the legislative session, correct?
Governor,
Correct.
right. And just as a point of clarification, from the staff's point of view, the way that we structured this bill, we did try to straddle here. We understand there's conflict in existing statute about whether it's the officer or the council that is making the investments. So what we did here, and the language refers to both of them, and so we were trying to kind of find a middle ground. And so, I mean, we gave some thought to it, but specific direction that we got, I suspect it's going to be kind of polarized. Yes.
Okay. All right, Lee, and then Stephanie. I apologize.
Yes, Madam Chairman, I would suggest that staff be directed not to represent an SIC opinion, a council position, on this language, whether it's the investment officer or the council. But when you're asking staff to represent the agency, they're going to go in with a perspective that they own. And I'm saying, since we have the vision on this issue, which needs to be resolved after we've got 3 new members on here, to make some changes to that, or have a chance to weigh in on what their position is, I would suggest that staff, while they're lobbying, while they're working with legislators, just says there's some division within the council, this is a legislative decision to make in terms of the language, and not represent that there's a preference one way or the other by the council.
Stephanie.
I would have to respectfully disagree.
Yeah, Lynn, can I ask you to defer? Lynn, I've got a bunch of folks in the queue, and then can you hold that?
Sure, thank you.
Thanks, Stephanie.
I just wanted to ask for clarification after that motion and that vote. So this will not, once it's dropped, will not be stamped with endorsed by State Investment Council?
No.
Okay.
I don't even know that, Madam Commissioner, that's a thing we could do. So we can get agency can source a bill, but and we can verbally express
support for the concept.
Yes, and that would be as far as we would go.
On that point, though, as Charlie has already mentioned, it's already been endorsed by the ILOC committee. So what we need to do is take that endorsement out of the equation as well.
Yep.
If we're going with this concept.
I understand. Okay.
Mr. Treasurer, we wouldn't represent it that way because it was a different bill at that point.
Okay. Tim.
Well, Madam Chairman, sometimes when you get in all these things, sometimes maybe you get staff that just put grape jelly on it and it causes a problem. But I would like to just suggest that if we all would take a minute and stop and read the 202 number. On the bottom of the 202 number, if you read that, it comes back and it has the 202 number is the number of the bill, and it has .4 SA. Generally, that's usually where the bill came from, which means that bill came from the state auditor's office. And so at some point in time, maybe not. I don't know. I'm just using, they have minimum style. State agency, okay, well, if it came from the state auditor's office.
No, but that's a fair question. That the way in which they used to identify the origination of the legislation. And I'm terrible at it now, too. I have to apologize to so many members, including the senator, that I'm using acronyms that were absolutely valid in 1995. And weirdly enough, they are did you say, Peter said I was in college? I like you more in this moment. And so it's difficult, but that's true. And I think that your point, and if I'm overreaching, Senator, please stop me, that you're used to it. And we just want to be careful. And that's the whole point of narrowing the motion about the spirit and the overall intent of the fund. And to make sure that the staff are clear, and I believe that you are, that we do. We believe this is an appropriate move and transfer, the details of which in this legislation. And to the other senator's point, there may be some disagreement about pattern, practice, and statutory requirement about the authority and oversight and how that's defined. And if they have technical questions, you'll provide them those technical answers. We have minutes that show those disagreements from prior meetings. They can look at that. They've got current statutes. That's the whole reason you've got FIRs, analysts, committee staff, and the Legislative Counsel Service. So we're clear that that process will move forward. And then we'll see if a bill passes. We'll look at the specific language. Okay. All right. Very good. Scott.
You mentioned something as it relates to this bill, not this broader conversation, but I don't know why we as a council don't ask staff to develop an FIR where everybody here thumbs up, thumb down on the language of the FIR, and that's what we submit. That's what the FIR process is for, as far as I understand it. That gets away from the Greek jelly and people worried that staff are going to say something that they're not supposed to say. Submit an FIR that's approved by this council. End of story. Isn't that not the right way to?
Well, we certainly could. It's not always that an entity that supports a particular concept does that fiscal impact. Usually I find it someone who isn't going to help me does the fiscal impact and review. But it is a fair point that there are varying vehicles to see what independent opinions are about what this language means or doesn't mean, and whether or not the intent of this body is being met. And I certainly would defer to the group about what's the best way to move forward. I mean, it seems to me that we're close. And it seems to me that if we have the only negative, the downside, and we're taking too long in our meeting now, the only downside here is that if we don't get some of these issues addressed on the front end, it doesn't get changed, comes right back, there's still questions, and then the council can't endorse the concept. That is a bit problematic, which is why I wanted to know what the kind of governance is during a legislative process. Because if you can get that resolved, that seems to me to be a far better situation at the end of the legislature than not. And without being part of all these conversations in the past, I'm a little bit hesitant to just say it'll work itself out. But that's the only issue, and I think that's what Scott's getting at. If we could come up with an agreed, here are some things that need to be addressed. Here's the current review of what the language says, and whether or not it's consistent with current statutory requirements, and then see what the council thinks. I certainly wouldn't object to that, but I want to be careful that we are timely in the efforts that we need to undertake. Lee.
Governor, I would just suggest to you that it's impractical to strap staff on the FIRs, particularly as you get later in the session. The staff has got to be able to respond quickly.
Correct.
And get the FIRs out. To have the council have to rubber stamp or vote on it, I think is inappropriate. I think it's particularly critical that staff understands that. And I think staff does know the conflict that we're having, and it doesn't represent anything in there. But I would not want it to come back here, and I don't think it's appropriate to do an email type vote. I think then we have open meetings issues. I think we have to delegate the staff to do the FIRs.
Do the work.
Right. And just don't step in it.
And Governor, from a staff perspective, we welcome feedback, whether it's right on point or diametrically opposed. We'll take that into consideration and filter it appropriately. I mean, when we speak on your 11 voices, and we try to synthesize those to the most productive way possible. It's not always easy. As you know, this bill's been kicked around since November.
Okay. Any other comments to that? And thank you for getting Olivia up to speed. She's very grateful.
Thank you, Governor.
Thanks for letting me tease you, Olivia. All right, so now we are...
Make that very brief, Charlie.
All right, Charlie, you're back to you.
The Treasurer requested we mention or discuss these two bills. We have House Bill 50 and Senate Bill 57. Both of these are transparency type bills. Both of them have been introduced before. We've done an initial run through on both of these. We will not oppose them. I think House Bill 50 basically asks that our audit be presented to the State Board of Finance. We have no issues with that. That's fine. It's unclear what the bill the intent is, or what the Board of Finance would do with our audit, but I mean, maybe it would be apparent at that point. Senate Bill 57 has several layers of additional disclosure that would be required not only for the SIC but also the other investment agencies. Generally, we agree with these being disclosed. Generally, they're already disclosed as line items in that monthly reporting we do. It covers, there's a lot of coverage that's already out there. So in that sense, we're already doing most of this, but we won't oppose the bill. That is our position on it at this point.
Thank you, Governor. I appreciate the comments, but before you get out of the room, and this is an entirely different thing, so I'm kind of pushing outside the barrier. Before you and the Secretary get out of here, can I talk to you about SNAP and Section 8 and the federal shutdown?
Oh, can. And so I have a couple of quick things. I have a press conference right now announcing additional folks, which should make Olivia happy. She's running several departments at once. And I want to defer back to Peter, but I just want to throw these out for new business with realizing that we're still finishing up, and we'll make sure that we're available, Mr. Treasurer, to work through those other things over the press conference. But I would love to have a deeper dive on management fees. And while we got some good information today, because that continues to be an issue by the general public, making sure that it's easy to identify how much, not just the percentages and what the patterns and practices and what those standards are, but to really take a look at it. I think that we do a better job explaining our decisions and our efforts to the general public. And in that, for the next meeting, I'd love staff to bring to us some proposals about more educational materials about this body and about our work. It was a major source of both pride and consternation, certainly during my campaign, about whether we're meeting our statutory opportunity here in terms of investing, making sure I came at the back end of the land commissioners. What I believe you were sort of alluding to is more investments that were local economic impacts, how we assess those and judge those, how those could become part of the portfolio. To do that, we need a little bit more detail, and I'd love that, those educational briefings or that information to at least have a conversation by the council about what that could look like. So if you bring some proposals, I would appreciate that. And if there's something I missed, I don't know if the chief of staff will still be here or he's following me out. Or Olivia, if there's something I missed, you can do that. And I know that I might potentially miss public comment as a result, but we will not adjourn until we get that. Yes, sir.
I was going to ask if you could have public comment.
Absolutely.
Yes,
Absolutely.
We're getting there. Yes.
That's my fault. I apologize. These meetings take a little bit longer because I'm engaging.
But we would never any of these meetings. This is one of the shorter ones.
Is it? Well, thank you for coming. It means a lot to us that you participated. As you can hear, I want us to do it a little bit differently with more information because I want more public participation. I think that that's important. So thank you. So I will dismiss myself again temporarily, potentially, and Peter, you're back in charge, and then I'll come back if you haven't adjourned. Thank you.
Can you give us a heads up about what you're going to tell everybody?
No, I will not.
There's no media here or anything.
We're going to announce 2 more secretaries. Yay!
All right, the next meeting of this council will be in February on the 26th here at 9 a.m. Now, public comment. Has anybody signed up, Carrie?
Here's the list of students here. I don't think all these people are coming. I'm sorry.
If I could just have you turn
Carrie, there's a list.
Yes, we have one gentleman has.
All right, well, before you start, let me just remind, our practice is 5 minutes exactly, and I'll keep time. I even have a gavel. And the council, unfortunately, cannot get into a debate or response, so we're happy to get your input, and we'll take it into consideration as we debate matters in the future, but there will be no response. Go ahead.
Yeah.
Okay, thank you. My name is Kenneth, Chairman and members. Kenneth Segura Knoll. I own Knoll Global Business Partners. We do business development and we do investing in New Mexico. I wanted to come before here to encourage that the State Investment Council look closely at the opportunity zones that have been delegated by the state as investment opportunities. I'm going to read this so that the opportunity zones were established by Congress in the Tax Cut and Jobs Act in an innovative approach to spurring long-term private sector investments in low-income urban and rural communities nationwide. The program is based on the Bipartisan Investing Opportunity Act. The program establishes a mechanism that enables investors with capital gains tax liabilities across the country to receive favorable tax treatment for investing opportunity funds that are certified by the U.S. Treasury Department. The opportunity funds use the capital invested to make equity investments in businesses and real estate and opportunity zones designated by each state. Our company, we've designated 3 projects, actually 4 projects. One in Gallup. We're working with the Gallup Land Partners, and we're working with the Navajo Nation. One in Los Lunas and one in Carlsbad. So, as one of the senior managing partners, my task is to go out and find money and find those investors who are looking for that tax write-off. Real briefly, there's $2.3 trillion in unrealized capital gains. So as I call and I talk to people, mostly like the firm that was here, about investing in New Mexico and getting those capital gains, they say to me simply, your own state doesn't invest in yourself. The State Investment Council and them don't invest in themselves. You know, I've been around. You know, it does. That is a message that, true or untrue, I correct them. Our projects have over $1 million of state investments by LIDA and other incentives, but they quickly say, you know, where's the cash investment? Where's the cash investment? We need to figure out a way that we start investing in New Mexico. I keep hearing that our mission is you know, to get the best deal. I would suggest, like the bill itself, it's giving investors an opportunity to take their gains and invest it in areas that need the investment, so that they don't have to pay taxes. Now, you don't pay taxes on those gains, but once you realize those gains, I don't understand why you don't take a percentage of those gains and reinvest it. And now what is designated are opportunity zones by the state. Those investments could be used to encourage private investors to invest. And I'm here to, you know, it's January, we're a new governor. Hopefully we have a different, you know, direction from some, and I want to, you know, defend the SIC. They do have some investment going. They've tried very hard, but I think it's got to be a bigger program. It's got to be a bigger approach, a different approach. All these funds have to operate through opportunity zone funds. Okay, so I know of 3 organizations or 3 investment groups in New Mexico right now that are setting up opportunity funds. Thank you.
Thank you very much. Okay, we are adjourned, and we will see everybody at the end of February.